অন করেছি। Good evening everybody. A very pleasant moment. Lecture series 22, 23 and 24 on the day 11 will be held today. Three honored speakers for this session are here with us today. Shreya Basu ma'am's lecture will be given in the first half of the session from 6 to 7 pm. Then Dr. Madhumita Dasgupta ma'am takes the session from 7 to 8 pm and Dr. Abhijit Kundu sir will lead the last portion of the session from 8 to 9 pm. I now turn the task on to Sukarna Bhattacharya ma'am for Shreya madam's brief introduction. We much appreciate your help and cooperation in this case. Thank you.
Thank you. Good evening. So the first session will be taken by Shreya Basu ma'am. Shreya Basu ma'am presently serving as state-aided college teacher in the Department of Commerce, Scottish Church College, Kolkata, and she has done her M.Com from University of Calcutta, followed by MBA from Raiganj University with a gold medal. She had wide-ranging interest in the field of accounting, tax laws, auditing, and financial management. She has presented several articles in national and international seminars and also published number of research papers in different reputed national and international journals, including seminar proceedings and edited books. Over to you, ma'am.
Thank you. Thank you for the introduction. Good
Thank you,
evening.
ma'am.
So, the thing is, actually, the discussion today is regarding audit, which I know for, and since it's like the exams are also upcoming and everything, and it is one such topic which is maybe sometimes a bit tricky for students who always tend to say that something is not right. So, anyway, hope we have a good, fruitful session. So the thing is, to begin with, since we have 1 hour, so today the topic that I thought of discussing, having a discussion regarding is the audit procedures and technique. So we keep on hearing regarding audit, like as for an auditor, who can be an auditor? It has to be a practicing chartered accountant or firms, or what are the qualification, disqualification? We keep hearing like what can be the remuneration pattern, rights, duties, etc. But what I wanted to discuss today is like when we speak the term audit, like the auditor is going to conduct audit in a company. So what does it actually entail? So that is what we have the discussion for today. So regarding audit procedures and techniques. So can I share my screen? Will that be okay?
Yes, ma'am, you can share your screen.
Okay. So for that, I'll be sharing my screen right away. So the overall audit procedure, as we talk, it can be broken down into 4 steps. So to start with, if I say, like the first and foremost, whenever a company approaches an auditor, like suppose a company with their different process, they decide that they want an auditor to audit the firm. Now the thing is, when they approach an auditor and the appointment letter is provided, now the auditor needs to undergo a few background check. The auditor needs to take certain steps before commencing his actual audit work. Now the thing is, if we distribute this whole idea, like what he needs to do and what all before the step and after the step, what we can say is, for the preparatory steps that he needs to take before commencing the audit, actually before he accepts the appointment, he needs to do some work, some background check, and if he is satisfied with those, then he can move ahead and he can accept the appointment letter. And then he can, after that, he also has to take certain other steps. So since we have discussed, like since it has been broken into various categories and subcategories, so again I'll be sharing the screen. So regarding the first step, what we will discuss is, so before actually accepting the appointment, the auditor needs to take steps like he needs to check the validity of the appointment letter. Now, when an appointment letter is provided to the auditor must ensure that it's a valid appointment letter. It is provided by a valid authority, like the proper shareholders. It is coming through the right channel. Then the overall general knowledge about the business, or maybe actually what does it entail? What does the company expect him to do in his audit work? The remuneration, the billing arrangement that is required for him. And most importantly, one very important thing that the auditor needs to do is he needs to communicate with the previous auditor. Now the thing is, maybe because now audit term is segregated, so if an auditor is auditing in a company, if he's auditing, he's practicing individually, then he does so for a period of 5 years. And if he does so as a firm, then he does for two periods of 5 years each, that is 10 years. Now the thing is, if the previous auditor's term is over and then someone else is appointed, still as a formality, the new person who is supposed to be appointed should communicate with the previous auditor to find out maybe the general background of the company and what is that auditor's idea on the company. And in case the auditor is the previous auditor is removed before his term or he resigns, then most definitely the new auditor who is supposed to be appointed, he should first check with the previous auditor, and only then, if he is satisfied, he should accept the letter. Now the thing is, once he accepts the appointment letter, like he's satisfied about the background of the company, about the appointment, he then accepts the appointment letter. Now after that appointment letter is accepted, then he actually he will have to start with his audit work. Now for that purpose, he needs to take certain other steps as well. Those steps include, he needs to get himself acquainted with the enterprise, with the organizational structure, like maybe the hierarchy of work, who reports to who is authorized for doing certain transactions, because for his audit purpose he would be requiring all those things. And also about the enterprise, suppose the enterprise is working say in the IT field, or maybe it's a chemical company. Now regarding the background, how it works, the auditor also needs to get himself acquainted with it. Now, and other than that, with the accounting system, like maybe, like for example, say like the policies the company follow, or maybe the depreciation, the pattern in which they charge the depreciation, whether there is any change in method. So more or less, and very importantly, the auditor needs to find out regarding how good the internal control system of the company is, who is in charge of it, who's preparing what. So these things, and also the internal audit department. Now auditor needs to get himself acquainted. So as a first step, when an auditor goes about for accounting, for auditing the company, then what they do is, initially they before accepting the appointment, they do a thorough background check. If they are satisfied, they accept the appointment. If, and then moving on, like when they accept the appointment, they do a background check about the company. They get themselves acquainted with the whole company before they actually start with the audit process. Now, in the second step of our work, as it was already shown, so step one involves the preparatory steps. Step two involves his planning of the audit work. Now, when you talk about planning the audit work, actually what we mean is two very important steps are involved here. One is making an audit plan, and second is making an audit report. Now, an auditor randomly cannot just start with his audit work. He needs to know exactly what to do when, the nature, the extent, the timing of his audit work, how he is going to do the work. So, for this purpose, SA 300, as published by ICAI, has given certain guidelines, like what is to be done by an auditor for the planning purpose, what is his responsibility, and more importantly, whenever an auditor plans his work, his strategies are in place. He exactly knows how much time he is going to allocate to which department or which area of the work. So that way, what happens, the whole audit procedure is very systematic. I mean, no extra time is given to one area and another area is lacking time or work. That doesn't happen. So that the auditor can spread his duty, his work over the whole period, over the whole work properly, over the whole company, and he gives equal importance to all areas. Or maybe the areas which require more importance, he may give those areas more preference in his audit plan. So that is the first idea regarding an audit plan. So after the auditor, as we discussed, the step one, where he gets himself acquainted with the enterprise, what he then does is he jots down a plan of his work. So he exactly wants to know all the relevant information about the client. Like, in order to entail his audit work, in order to actually move on with his work, he prepares a plan. Now the plan is his idea, like this many months I need to do the audit, or maybe in every, say in sales department, I'm going to allocate 1 hour, 1 day, or maybe 1 month. In the, say in various geographical locations in different factories, how much time I'm going to allocate. So these things are decided by him. Next, what he does is, so this is the basic idea, like this is his plan of doing work. Now what he does is, he needs to actually execute the plan, and there comes our audit program. So here what happens is, he prepares a program for himself. That is, he exactly jots down, he exactly decides like from which area to which area who is going to cover. Now, for this audit program, there are various activities and, of course, there are various advantages. Number one, once the program is in place, it is very well placed. That is like the overall audit program, who is going to do the work, when they are going to do. So, what happens is, auditor exactly knows where his situation is regarding his audit work, how far he has gone, or maybe how far he should have gone with the program. This is one very important thing. Next is, he can allocate specific people of his team, of his overall audit team, to the specific areas. So in his team, someone who is a tax expert, then he can allocate him to do the audit work regarding that. A person who has experience regarding stock taking or maybe inventory management, he can allocate that person to that purpose. So the right man in his team can be appointed in the right place to do the correct audit work. Next is, he exactly knows to whom, to which team member he has allocated which work, maybe in which department they are doing the audit, for how much time he has been given him. Now, later on, if it is found that in one of the department the audit has not been done properly, or maybe in one area the work, like the data collected, the evidence gathered is not enough, it is not sufficient, then he can exactly pinpoint which person was responsible for that in his team, and he can question that person why the data is not there, or maybe like get the explanation why it could not have been gathered. So that is the importance of an audit plan, a program. And next thing, another very important thing is, when you have a written documentation, your program, firstly you can keep a track of your work. Secondly, just in case later on the company puts forward a complaint that he did not do his work properly, and maybe a court case comes through because of that, so the auditor may actually put forward his audit program and show like this is the exact time, this is the exact period, the record of which he has done his audit work in what method. So basically, this is something which is very important from the auditor's point of view for his efficiency in work, as well as for as an evidence. And like the whole audit work is done, you see, an auditor basically is ultimately required to give his opinion, like as to what he feels, using his own professional skepticism, his own judgment. He needs to give his opinion as to what he feels, how the audit should be done, or what kind of like the reliability of the financial statement of the company. But the thing is, for doing that, he cannot just plain and simple give his opinion. He needs to provide evidence proving that opinion, supporting that opinion. So, as he prepares the audit plan or the audit program, the basic idea that is behind his mind is, while he is doing the audit, he needs to collect evidence. He needs to gather evidence. If he wishes to say that something is not up to the mark, then he needs to have supporting documents stating the same, because he cannot just come and say and that this is not a clean, he is not giving a clean report and he is giving a maybe qualified report. He cannot just say that, because he needs to give supporting fact. So in the audit program, it is also included like what kind of evidence the audit team needs to collect. So the auditor may decide on preparing his working paper in a certain manner. So how the working paper is going to be prepared, or maybe he decides to prepare an audit memorandum or an audit file. So certain important matters in the audit file will come in the permanent section, certain will be coming in the temporary section. So these things will be decided in the program itself as and when he is doing the audit work. So here what happens is, so first he's appointed, then what happens is he makes his own plan how to work, and then he puts that plan into execution in a format, in a proper format in the program, where exactly the date, time, place, nature, extent of the work is classified. Next, that we move on to is the step three, which is actually conducting the audit procedure. So we have been seeing like the auditor is appointed for this, the auditor is expected to do certain thing. Now, this step three is exactly the bulk of the audit work that he actually does, he and his team together. Now, the thing is, overall, this audit procedure, so when the auditor actually makes his plan, his program is ready, then what he does is he actually starts with his audit work. So, in his audit work, first thing that he does is the compliance procedure. Depending on the result that comes out of the compliance procedure, he does his substantive procedure. Now, in the compliance procedure, what we see is basically what the auditor does is he checks the internal control system of the company. Now, internal control system of a company is basically the like it is like the it is a system that is developed by the management to keep a control over the company and also make sure about the effectiveness and the efficiency of the running of the company. So, internal control system is basically like a sieve. All transaction, everything passes through the internal control system. Now, if there is a very good internal control system, then it would be able to detect every erroneous transaction, every fraudulent transaction, or any transaction of unusual nature. Those transactions will be held back so that these cannot enter the firm, enter the company. Now, if a company already has a very good internal control system, then you can say almost half the work of the auditor is done, because the auditor can more or less, not never completely, but more or less trust on the internal control system of the company. So, first and foremost, what the auditor checks is the internal control system existing? This is the first thing that he checks. Like, is there an internal control system in the company? Next that he checks is it effective? Now, effective in the sense, now suppose the internal control system is working in four departments and the rest three it's not working, then it is not an effective internal control, because transactions are being controlled in four departments, not the other three. Next is like suppose if it is effective, say the internal control is working only for a few specific transactions, then also it is not completely effective, because all the like internal control system, the main aim is it has to create a system where all fraudulent, erroneous, unusual transactions are held back. Now, if it is not an effective internal control system, then it is of no use to the auditor. And next is the continuity of the internal control system. That is, suppose you have a very good internal control system, but it works for 6 months a year, or maybe it works for 8 months a year. If that is the case, then what happens is, again, the chances of the fraudulent transactions to be held back is only existing for 8 months, not the other few months. So that is why the auditor first checks, is the internal control system present, existing? Is it effective? And is it continuously working, operating for the whole year? Now, this is the compliance procedure. Now, once this compliance procedure, the results are out, that is, the auditor himself finds out for himself. Suppose the auditor sees that the company has a very strong compliance procedure. That means what he can do is his actual substantive procedure, that is the bulk of the work that he's going to put on, he may be a little bit light on that, because thinking of the fact that since the internal control is good, so the control risk is already reduced. Now, if the control risk is reduced, then even if he goes a bit light and his detection risk is slightly high, it wouldn't matter, because his overall audit risk would be low. But the thing is, if he finds out that the internal control system is not up to the mark, that is, the control risk is already high, then what happens? If he is not very thorough with his work in his substantive process, then the detection risk will also go high. Now, if already inherent risk is something which is not in the control of the auditor or the company, now control risk is also going high because the internal control is not good. And if the auditor is slightly like not very thorough with his work, then the detection risk will also go high. Then what will happen? The overall audit risk will go high. Now the auditor cannot take that risk. So if he sees that while like in doing his compliance procedure, that his internal control is not good enough, what he does is he makes sure that his substantive process is very thorough. Here, actually, what happens is he in substantive process there are actually two parts. One is the test of detail, another is the analytical procedure. Now, in test of detail, actually the real time work is done. Here, what happens is the vouching and the verification is done. So here, vouching in the sense the test of all transactions are checked. That is, every single item that is coming in your PL statement, that is all your income, all your expenses, it is checked thoroughly. Documentary proofs are checked. Like regarding a transaction, you have various notes, you have third party confirmations, you have inspections and observations, results regarding every single income and expenses checked via vouching. And as for verification, what is done is, in the verification process, what we do basically is we check the balance. The test of the balance is done. Now, test of balance in the sense the balance sheet items are checked. That is, the balance of the assets and liabilities are checked. how accurate are these figures, are, say for example, whether the depreciation is being charged at the right rate, is the asset actually in the name of the company, the ownership of the asset, does it belong to the company, is it being upgraded, is there any addition to the asset, is there any kind of deduction or sale of any part of the asset, or maybe the valuation of the asset, is there any proper arithmetical accuracy. All these things are checked in verification. So basically vouching and verification are the thorough point to point check that the auditor and his team they undergo in their audit process. Under vouching, every single income and expense items, revenue and other income items, the sale items, what is done is, with documentary evidences, with third party confirmation, it is checked over the time. And regarding verification, what happens is the balances. Actually, the asset and liability, does it belong to the company at all? Is it in the name of the company? Is it being upgraded? These things are checked. And next part of the job of the substantive procedure that the auditor needs to do is the analytical procedure. Now, regarding analytical procedure, actually what happens is, in analytical procedure, what we do is we analyze the detail, right? So in analytical procedure, actually what we undergo is, now, suppose I have done my test of detail. I have done, as an auditor, I have done my vouching and verification. I have seen, like, suppose my gross profit for the year is coming to, say, 10%. And I have checked. Now I see all my income figures are correct, all my expenses figure are correct, they are disclosed properly. I have got confirmation from different sources. I have all the physical documentation, documentary deed, like the invoices, the passbook extracts or the bank statement extract, the cash book extract. Everything proves that my income and expenses are correct. So I am quite satisfied that the gross profit figure that I came to, which is giving me a profit percentage of 10%, is correct. Now the thing is, if I do not compare this data with the data of my past years or with the data of other companies in my industry, then I will not be exactly be able to say what is the exact position of the company. Now suppose if I do ratio analysis and I check data from the past years, I see that over the last 5 years my company had a profit percentage of 30 to 40% per year. This year it got a gross profit percentage of 10%. Then it is not a very good figure. Then I, as an auditor, I need to find out what is the cause of this downfall. Now if I did not analyze it, if I did not undergo the analytical procedure using different statistical tools like trend analysis, ratio analysis, I would never be able to find out that my gross profit situation is not good. Had I only done my test of detail, only done the vouching and the verification, I would be happy with the fact that I have got a gross profit and it is actually a true gross profit. It is not a story, it is not a window dressed figure. But only because of the fact that I did my analytical procedure, I found out that my situation is actually not good, because there is a sudden reduction in the gross profit percentage as compared to other years. Or maybe say companies in my industry, in the industry in which I perform, other companies on an average have got a gross profit of 30%, whereas I have got a gross profit of 5%. So I'm not in a very good position. So these things, these comparisons can be only done if the auditor undergoes analytical procedure. Here what happens is he checks the historical relationship so that he can actually suggest the company as to where they can improvise, how they can move ahead. So he can undergo different kind of liquidity tests. He can run liquidity ratios. He can run various different kinds of profitability ratios in order to see how the company is performing, what is their exact position right now. Now, when so like in the substantive procedure, overall that we have checked that the completeness, the accuracy, the validity, and the propriety of the data is checked. That means, as you can see from this chart, that is in the audit procedure. So in the test of detail, vouching verification basically is the part of the job where the auditor is checking every single detail point by point. And in analytical procedure, what the auditor is doing is he is comparing these financial data with other companies or my company's past data. So this is the bulk of his work. That is the substantive procedure. So here, as we discussed, that compliance procedure, if while after doing the procedure, checking the internal control, if the auditor is not very satisfied, then the substantive procedure that he undergoes has to be very thorough. So basically, he he has to do sampling maybe, but he would it would be much better if he does audit in depth, or like his routine checking is very thorough, because he cannot have a lot of sampling done, because he is making sure that his work has to be very thorough. Now for doing that thorough work, he needs to ensure that if I am giving my thorough work to in order to find out like the result that is coming out of my like my opinion that I have to give is correct, then he needs to make sure that his detection risk is reduced. That means that the risk of the risk that he detects, that he does his whole audit work, but then after that, even though he has done his whole audit work, still some kind of error or misstatement is remaining, this needs to be reduced. For that, generally we know that auditor always does audit sampling, because suppose there is a huge bank, a huge say public limited company like Reliance Industry or maybe SBI. Now when you're doing audit of these such huge organizations, it is not humanly possible to go through every single transaction. So generally sampling has to be done. Now in case the substantive procedure needs to be strong, then maybe the sampling technique that is used by the auditor has to be much, it cannot be haphazard or it cannot be simple random. Then maybe he has to go for a cluster checking, or maybe he has to go for a stratified sampling. He has to use scientific methods basically to ensure that at least it is not as random as it can be. It is very systematic in which he is collecting his sample, and the sample size is quite big, so that he cannot have errors in spite of doing his whole audit work. So this is the idea, like this is the bulk of the audit work that the auditor does. So basically, like the quick revision is, auditor is appointed. Before accepting the appointment, he checks whether it's a valid appointment, whether it's a good company, converses with the previous auditor. Then after he accepts his appointment, what he does is he goes through a background check about the company. He learns about the company, its structure, etc. Now, based on whatever he finds out, he prepares his overall audit plan, and his audit, like in the audit plan, he has a thorough detail regarding how he is going to do his audit. And the execution of these plans in a day to day timely manner, the extent of the execution, everything comes in the audit program. Now, after that program is prepared, auditor and his team actually goes about into the work. So first thing, the procedure that they undergo is the compliance procedure, where the internal control details are checked. And next, what they undergo, depending on the result of the compliance procedure, is the substantive procedure, where the test of the detail, that is vouching and verification, is done, and also the analytical procedure is done. Now, after this, like after this all this process is undertaken, what the auditor next does is, depending on the result that he gets, he finally provides his opinion, stating whether the financial statement is actually giving a true and fair view or not, because that is his main aim, that is what he needs to talk about, whether the financial statement of the company is giving a true and fair view or not. Now, the thing is, we always have been hearing that audited financial statement, audited PL account, audited balance sheet. The importance of the term audited, why we focus so much over there is, you see, when we talk about a company, generally we involve two big group of people. One is the owner of the company, another is the management of the company. So management of the company is basically the board of director who runs the company. They get their salary, they are running the company. But the owner, who are actually providing the capital by buying equity shares, these people, they they are actually not involved in the running of the company, but it is their company, since they are the owners, and it is their money which is at stake. Now what the shareholders do is, they want to ensure that their company is being run properly by the board of director. Every single rules regulations are being followed, and the company is being run effectively and efficiently. Now in order to ensure that, what the auditor does is, or sorry, what the shareholders do is, they appoint an unbiased third party on their behalf to check the fairness of the and the reliability of the financial statement prepared by the management of their company. And this unbiased third party is basically the auditor. So that is why we have seen all the disqualifications associated with the auditor. that auditor can in no way have any kind of dealing or liability with the company, because if that is the case, then their unbiasedness is no longer valid. That is the reason why we have such a long list of disqualifications of an auditor. Just anyone cannot be, just because a person has a practicing certificate and is a chartered accountant does not make him acceptable as an auditor in your company. You need to do also check like whether this a person is actually eligible to be the auditor, and he does not have any of the disqualifications. Now, the thing is, when the auditor is checking the overall financial statement, they are checking the data. The auditor uses his own professional judgment. And of course, the auditor always has his professional skepticism. That is, he needs to have a questioning mind. Whatever data is given to him by the management while he is doing the audit procedure, he cannot accept that data just on face value. He needs to clarify. He needs third party confirmation. He needs documentary evidences, because he needs to have backing evidence to prove every single thing that he does. That is the reason the auditor prepares his audit notebook, where every single important information that he has gathered, he makes a detailed list of it. Now, as you know, like an auditor is generally, when an auditor is practicing as an individual, he's appointed for a period of 5 years. And if he is practicing as a partner of a partnership firm, then he is appointed for two periods of 5 years each, that is 10 years. Now, in that whole period, when the auditor is auditing, there may be some important facts like the memorandum of the company, the article of the company. These have valid importance for all 5 years. So these will form a part of the permanent audit file. Auditor maintains these evidences, these data. And every year, as he's checking the financial statement, because every year he needs to prepare his report where he has to give his opinion about the fairness of the financial statement. So, there what happens is these matters, the important information that he's gathering for that one financial year. So, what he does is he prepares the temporary or the current audit file. So these are all different kind of evidences or documentation that the auditor needs to undergo while he is doing his audit procedure. Because until and unless the evidence is appropriate and sufficient, the auditor cannot give an opinion. Because always remember, in step 4, as we have said, like after the audit procedure, auditor compiles the whole all the data that his team has found out, that he has found out. He sits and decides what kind of opinion is to be given. Now, generally, we know that there is the clean opinion and the qualified opinion. And in qualification, we have different kinds of opinion, like disclaimer of opinion, where the auditor is actually not able to give any opinion because he did not have material time to do his work. He had material limitation on the scope of his work. Or maybe there is an adverse opinion, that is the auditor is in complete disagreement with the management of the company over some material fact. Or maybe there is a simple qualified opinion, that is maybe he got time to do, but maybe not so material, but still he did have limitation on the scope of his work. Or maybe there is a disagreement with the management, it is not that material, but still the disagreement is there. So auditor is unable to give a clean report, he gives a qualified report. Now, whenever this kind of qualification is given by the auditor, he needs to quantify that qualification. He needs to exactly say why he is giving that opinion, why he is qualifying that answer. Or like overall to the management, he needs to give that answer why he is quantifying qualifying the or with like the financial statement. So in that case, the auditor needs to gather his audit evidence. Without those audit evidence, without those working paper, he has no way to prove his answer, no way to prove to the management his own point. So in the audit procedure, as we are seeing, like these are the work the auditor does, you need to remember something else also. Along with doing his work, he needs to keep track, he needs to keep a record of these work in the form of audit evidence. Because as we know, written documentation always have more validity than oral documentation. Oral documentation always have more validity than oral documentation. It has more validity than oral documentation. Now, suppose an auditor is handed over the evidence to the management. One important more towards the evidence gathering. Suppose the evidence is completely different from the one that the auditor himself has gathered. Then what he's gathering is completely different from the one that the management has gathered. the management, because professionally a scared person, he cannot take on point blank whatever the management is handing him over. He always needs to have that suspicious thought, he needs to have that suspicious mind, cross checking, double checking everything twice or thrice before he comes to an opinion. So this is the final step, etc. What the audit itself, like generally when the audit is done of a company, it is according to the company. Being a chartered accountant, he is bound by the different kinds of auditing standards as provided by the Institute of Chartered Accountants of India. So in SA 700, CA Institute has given a pro forma as to how the report is going to be, what are the different kinds of opinion that can be in that report, what are the different kinds of opinion that can be in that report, what are used by the auditor. So all these things needs to, when the auditor is preparing the audit report, he needs to keep in mind the different provisions of the Company Act. He needs to keep in mind the different provisions of the CA Institute about the, according to these different kinds of different rules and regulations, the auditor has to ensure that the ensure and say that there is proper disclosure of all material item. That is, there is no item that is uh, like it is not clear, it is not clearly mentioned, or all the gaps are followed, all the accounting standard relevant accounting standards are fulfilled by the company, the relevant auditing standards are maintained, then all the material rules regulations of the country is followed. These are the basic things the auditor needs to check. And more importantly, he has to make sure that the financial statement that is being prepared, it is giving true and fair view, not just arithmetically true and correct, but also the fairness has to be checked. So this thing is the final work, final step of the audit procedure. That is, the auditor has to ensure that the all the work that he has done, he can actually prepare an audit report stating his opinion based on his work and the evidence gathered during his work. And the auditor in India till date can actually give only 5 different kinds of opinion. So either it's a clean report which gives a clean opinion, it's a qualified report which gives a qualified opinion, it's an adverse report giving an adverse opinion, or it is like disclaimer of opinion where the auditor himself is unable to give any opinion. Or sometimes what happens is the auditor emphasizes certain matters which may be of material importance, which may question the going concern of the company. Basically, why the thrust over here is because when the auditor is preparing the report, when the auditor is checking, the shareholder or all the other stakeholders, all the users of the accounts of the company, of the financial statement, they may not completely trust what the management is making, because the management, suppose the company needs a loan. Now obviously if the company has a good net worth, the asset is good, easily they will get the loan. So it may so happen that the management may window dress the asset position of the company or the profitability of the company. Now the banker needs to be sure that whatever financial statement is being handed to him by the management of the company is absolutely correct. So what the banker does is he also relies on the audited report, because as per the audited financial statement, the audit report, he is absolutely sure that a professional person who is qualified to give his opinion and who is also giving his unbiased opinion is actually giving the correct opinion about what the financial statement is. That is the main duty of the auditor as well. So, of course, it is his duty to confirm to all the rules and regulations and perform his own whole work regarding the audit of the whole company as and when he is appointed. But most importantly, after doing his work, he needs to actually give a report, and that audit report generally is addressed to the shareholder or whoever appoints the auditor. In case it's a government company and the appointment is done by CAG, then the report may also be directed to the CAG, or maybe it is directed to the central government. Now, the thing is, when the auditor prepares his report, it is in the format as given in SA 700, and in that format, he prepares the detail. Now, this report actually needs to reach the shareholder. Now, in the current globalized world, we may have shareholders all over the world. Now, it is not possible for the auditor to reach out to every one of them. So, it is the duty of the management to ensure that along with the annual accounts of the company, with the annual report of the company, the auditor's report also needs to be sent to every single shareholder of the company, so that every single shareholder knows exactly what is the position of the company which actually belongs to him. As even if you are one shares owner, then also you are the owner of that company to that percentage. But whatever it is, the owner is an owner, so every owner has a right to attend general meeting. Similarly, every owner has a right to receive this audit report along with the annual report, because this audit report will explain to the shareholder what has actually been happening to the company, to the money that he has provided to the company, how the company is being run, is it being run properly, are all the rules regulations followed, is every single transaction authentic, is there any kind of window dressing. So these things will be answered once that opinion of the auditor is read. Now, if we see in the audit report, the auditor has given a clean opinion, that means everyone can close their eyes and believe that okay, this is a correct figure. Now, this is one risk again about the auditor. Now, this is the reason why auditor has to be so thorough with his work, because once his report is out in the world, everyone is blindly believing that report. Now, if so happens that the auditor has done his work, maybe he was not very thorough with his work, or maybe he was not very he did not do a very in-depth work. Now, once he has done his work and he has given an opinion, now after that, later it is found that in spite of giving maybe a clean opinion, there are misstatements, there are frauds, there are errors still present in that financial statement. At that point of time, the auditor is going to be penalized heavily. He may be imprisoned as well, and he will be penalized according to different tax laws, of course according to the company law, according to the professional code of ethics of the CA Institute. So and maybe if the mistake is even very big enough, then his registration may even be cancelled. So you can understand auditor has a lot at stake, and that is the reason the auditor is so thorough with his overall audit procedure. He's so thorough while collecting the audit evidence along with his audit procedure, and also he has to be meticulous when he's preparing the audit report. So this is the overall, like the when we keep on saying that audit needs to be done about a company, or maybe audit is being undertaken, so these are the basic steps. This is what actually audit means. So it means that you will have to, like, there are steps you need to take before commencing the audit. You need to plan your work, you need to actually conduct the procedure, and depending on those procedure, and report is to be prepared stating whether true and fair view is given or not. So this is the overall idea regarding audit procedure. Now, when this audit procedure is actually undertaken, the vouching, verification, everything done, and finally the report is prepared. Now, for doing his audit, the auditor actually may use different kinds of techniques, different test methods. Now, testing methods like, the auditor can use these 5 test methods that has been mentioned. So auditor firstly, while, like, for in his audit procedure, while he's conducting his actual audit work, the auditor might actually inquire about a data. That is, he may inquire within the company, he may prepare questionnaires, different kinds of checklist in order to find out what his actual position is, or like he may actually direct questions, inquire the management of the company or the employees of the company, or even for that matter other third parties. Suppose there is a sale transaction, say a credit sale, which the auditor wants to make sure that has actually happened. What the auditor may do is, auditor may check the sales day book, auditor may check the credit note, auditor may get a third party confirmation from the debtor of the company, the auditor may even like find out from the management of the company whether the sale figure is true. So there are different sources, and even when actually a sale takes place, there are different invoices, there are different credit notes. So these are the documentary evidences also. So vouching is actually done. So for the purpose of vouching also, he may inquire from different parties. This is one test method in the audit procedure that the auditor may take. Next is observation. Now, say for a very big company, stock taking is going on. Now, it is not the auditor's duty to actually sit down and say calculate every single stock, or maybe say a hotel's audit is going on. Now, it is not possible for the auditor to actually go inside the kitchen and find out how much stock of what item is there, or how many bed sheets and pillows are there in the hotel. That is not possible. So the hotel staff does the work. Auditor actually observes it. Now, when the auditor or his team observes it, they can more or less understand, they can gauge with what importance this work is done by the like the team management team. Now, if they see that they are very casual about their approach, then obviously the auditor has to maybe undergo the whole work himself. If they see that they are very thorough about this kind of stock taking they are doing, then the auditor may actually observe the whole process and be satisfied about it, that it is they are doing the work correctly. Next is the examination or inspection of different evidences. Now, this is very important. Now, in order to do your vouching and verification, you basically need to you need to find out different evidences. Now, suppose the company says that there is a certain plot of land or maybe a factory building which belongs to them. Now, just because the management is saying that it belongs to them, the auditor is not going to believe them. Firstly, the auditor is going to check the deed of that land, of that plot of land, or maybe that factory building. Is it in the name, is the ownership in the name of the company? Next is, in order to make sure that that land belongs to me, we will have different kind of legal registered deed, registered paper that needs to be checked by the auditor. Then, for the sake of evidence, the auditor may actually check the asset register and see the date. Is it tallying when the asset was bought? Then the auditor may actually physically verify. They may go to that factory building, check the detail, the address, whatever description the management has given about that building, and make sure that okay, the evidence that they have gathered, the physical evidence and the maybe the virtual evidence, the paper evidence, it is actually confirming with the fact that what the management has said. So this is another part of the audit procedure, like when he is actually doing the work, with his inspection. Next is re-performances. Nowadays, what happens is all the companies more or less they follow different computerized method. Like suppose they are following Tally software. Now in Tally software, when one data is entered, then like all the relevant places, like suppose I enter a sales transaction, then in the sales account, in maybe the cash account if it's a cash sale, everywhere the corresponding entries have been posted. The employee fraud still more or less it is easier to catch, but if it is a management fraud, then it is quite difficult to detect that fraud. So what the auditor often do is they re-perform the whole work. So suppose they pass a journal entry, say it is just a testing journal entry, and they see whether all the effects that should come as per the software is it coming. Only if they see they re-perform the whole step, then they may understand that yes, the system software is working fine. Then whatever result has come in the general account of the software or in the like the different asset account, it is giving a correct figure. And then computer assisted audit techniques are also used. Now, this was something which was not used maybe 10-15 years ago, but nowadays, the overall business and especially post COVID, everything is mostly happening online. Now, when this kind of like work is done online, such a bulk load of work is done, then only physical verification, only physically verifying while confirming the audit procedure is not enough. So what happens is different kind of cat tools are used, computerized tools are used to make sure that all the entries, all the like maybe the banking, the work that is done in the computerized environment, that is done properly. So the black box testing, the white box testing, the around testing, through the testing, everything is checked through the computer system as well. So basically what we see is while performing the audit procedure, auditor is not nowadays not only just doing the, he's not just going to the office and checking the detail physically. Even in the computerized environment also, he is making sure that everything is guarded well, everything is checked properly. Because again, you see, this is a very important part of internal control. Because internal control doesn't necessarily mean you will safeguard your asset physically. It also means that you are going to safeguard it in every possible way so that your asset is safe. So a simple biometric or a fingerprint scanner is also a part of internal control, just like the guard standing outside your office door is also a part of it, because all of them have that aim of safeguarding the asset. Then different kinds of transaction information are fed within the computer system. Like a normal general transaction, this is the range of the transaction that we are going to have. So anything beyond and above this is unusual. So for this purpose also, you will have to make sure that the transaction that has been fed in is correct. So you use cat tools to make sure that even while like doing your substantive procedure or maybe your compliance procedure, you use cat tools to make sure that whatever you are checking is actually up to the mark, it is valid or not. So these are more or less the most important fights method, testing method. Initially, even the arithmetical accuracy was checked. Confirmation is also done. Other than this, like suppose the management says that the sales figure is 10 lakh, and management is showing me an invoice stating 10 lakh. But I asked the debtor, is the sales figure 10 lakh? And the debtor confirms, no, it is 8 lakh. So that means I have taken third party confirmation. Of course, this evidence that is gathered from a third party by the auditor himself is going to be more valid. So the auditor may question the management that why is the debtor saying it's 8 lakh? Maybe it's a valid mistake on the part of the management, or maybe there is an explanation. So if that is sorted to the auditor, it's fine. If not, then auditor makes a note, keeps that external confirmation as evidence. He maintains it in his working paper, and he makes sure to take it into account when he is actually performing his fourth and final step, that is when he's actually preparing his audit report. So this is actually what it entails as audit procedure, as audit work. So I guess this is overall the discussion that we wanted to have. And like for your syllabus point of view, this is something which is a very scoring chapter. And if you check the past papers, it is quite it keeps on different kinds of questions keeps on repeating, like the difference between substantive and compliance procedure, or maybe regarding vouching and verification, because this one chapter, audit procedure, has a lot of impact on other chapters also, because vouching verification is a part of your syllabus, internal control is a part of your syllabus, audit report is a part of your syllabus. So basically what happens is, if you have the base cleared in this one chapter, audit procedure and technique, your base for other 3 to 4 chapters are cleared. And that way you will be able to answer quite a lot of questions. If you check the university pattern, this is one of the very scoring chapters. So this will be very helpful if you can have an understanding on this chapter. And of course, you know which sections are applicable, which SAs are applicable, and answer accordingly. Because this is one chapter where you need your base cleared. If you have your base clear in this chapter, it is going to be effective in other chapters while you are answering your examination paper. And like as I always say, it is a very wrong approach to simply mug up things because it's a theory paper. It doesn't work that way. You need to have a thorough understanding of this chapter, because ultimately it's an honors paper, and it is very important that way since it's an honors paper. So you need to have a thorough understanding, for which reading of the original matter, reading and understanding of the original matter is very important. Because when you answer, even if you answer in your own language, it is fine, provided you give all the important terminologies, the sections, the essay numbers. These are very technical places to attempt. So yes, so I guess in case there are any questions, I would like to address them.
No, ma'am, there is no questions raised so far. So thank you, ma'am. The session was really very interesting. It will be really very helpful for the students. Thank you so much, ma'am.
Thank you. Thank you so much. Thank you for the opportunity. It was a very good opportunity to speak to such a good number of crowd, because that way I guess I can help even a little bit of students. Then it would be very good. I would feel very good if I can help a lot of students. Thank you.
Thank you, ma'am.
Thank you, ma'am. Thank you.
Thank you, sir. Thank you.
Please check your mail, okay, ma'am?
Okay, sir.
Okay.
Thank you.
So, sir, will I proceed to the next session?
Yes, yes, yes.
The next session will be taken by Madhumita Dasgupta ma'am. Madhumita Dasgupta ma'am presently serving as adjunct faculty at the Amity University, Kolkata. She earned her doctoral degree from the University of Calcutta. She had wide-ranging interest in the field of accounting, costing, business laws, and financial management. She has presented several articles in national and international conferences and also published a number of research papers or articles in different reputed national and international journals, including seminar proceedings and edited books. So I request you, ma'am, to take over the session. Over to you, ma'am. Hello, ma'am. Ma'am, are you there? You are kindly requested to take over the session.
একটু ওয়েট করো। ঠিক আছে সুকন্যা,
আচ্ছা স্যার।
একটু ওয়েট করে দেব।
হ্যাঁ স্যার, ঠিক আছে স্যার। Hello, ma'am. You are kindly requested to take over the session.
Thank you so much.
আচ্ছা
Am I audible and visible?
আচ্ছা
Because I
সুকন্যা,
can't see.
আচ্ছা সুকন্যা প্লিজ ইন্ট্রোডিউস ওয়ান্স अगेन।
Okay, sir. Okay, sir.
Am I audible and visible? First of all, sir, Shukanya, am I
Yes,
audible and
ma'am.
visible?
Yes, ma'am. You are audible as well as you are visible, ma'am.
Okay.
So now I would request, and so now I would introduce Madhumita Dasgupta ma'am. Madhumita Dasgupta ma'am is presently serving as an adjunct faculty at the Amity University, Kolkata. She earned her doctoral degree from the University of Calcutta. She had wide ranging interests in the field of accounting, costing, business laws, and financial management. She has presented several articles in national and international conferences and also published a number of research papers or articles in different reputed national and international journals, including seminar proceedings and edited books. Over to you, ma'am.
Am I audible? Yeah. Okay.
Yes, ma'am, you're audible.
Okay. Thank you so much. Good evening, everybody. Good evening, sir. Good evening, all the members present in the conference. I take this opportunity to thank everybody for and the organizers to allow me to join this lecture series. It's an honor. Today, I'll be discussing the topic which is a part of the syllabus of BCom in semester one, which is depreciation and its accounting. Right now, I'll be sharing the screen. Just let me know if the screen is visible enough because I'm not able to make out whether the screen is visible or not. Is it visible now?
No, ma'am, it is not visible yet.
Just a minute. Just see if it's okay now, visible or not.
Yes, ma'am, the
Sorry.
presentation has started. It's visible now, ma'am.
Yeah, thank you so much. Thank you so much, Shugana. Okay, depreciation. Uh, Let me just brush up on the fact that how we think and talk about depreciation in terms of accounting parlance. When I'm talking about depreciation, the first thing that comes to your mind is probably the meaning of something which is related to the fixed asset. Now, what is a fixed asset? A fixed asset, in very layman and in a very simple terms, if I am putting it that way, it means that the asset which is used by the organization for a long period of time. It transcends just one single accounting period and goes on for quite a couple of accounting periods. So if I'm following the standard accounting norms, my financial starts from 1st of April, goes on to 31st March the next year. So automatically, when I am having a fixed asset, of course, I'm getting the benefit from that fixed asset for n number of years in future. Not only in the year when I'm purchasing the asset, but it is also helping me out in the future when the asset is staying with me as long as the asset is having a useful life in my business. Now, when we had started accountancy, we had learned some concepts like money measurement concept, going concern concept. All these concepts we had learned long time back. There was a cash basis and accrual basis of accounting. All these concepts were there. Now, whenever we are discussing some higher topics, like depreciation, reserve, provision, capital expenditure, any kind of them, we always should keep in mind all the concepts or conventions which we had learned in accounting in the very basic classes, because in that way it would make it easier for us to understand that how the entire accounting process starts and where the accounting process goes ahead to. So the fact being, in case of depreciation, when I say the depreciation is actually related to fixed assets, and fixed assets is something which is of capital expenditure in nature. Yeah, capital expenditure as in, when I have expenditure which is for of a capital nature, then that becomes my capital expenditure. Like any kind of expense on fixed assets is my capital expenditure. Any expenditure which is not related beyond one accounting period is my revenue expenditure. So, if I'm talking about a capital expenditure which is a fixed asset, then automatically that is going and giving me benefits for quite a number of years. So, automatically, depreciation is related to only those assets which are giving us benefit over a number of years. Now, the first thing first, let us understand what is depreciation. Depreciation is the process of allocating the cost of the fixed asset, including excluding any residual or scrap value, over its estimated useful life in a systematic and consistent manner. Now, When I say that there is a useful life, we already know what is a useful life. As long as the asset is giving me benefit, that becomes the useful life of the asset. In case of the asset, the when the person or when the organization is purchasing the asset. So if the asset is suppose used purchased in 2000, for example, and if the organization is aware that this asset will give it benefit for the next 12 years, then the useful life of the asset is 12 years. Now you might feel, or the students might get confused, that if it's 12 years, what does it mean? That means the asset will just break down one fine morning after the 12th year. Probably it will happen is the asset will actually not break down, probably it will turn into a scrap, and that also will carry some financial value, which will also benefit the organization if the organization goes and sells that scrap. So therefore the cost of the fixed asset is actually the part which is excluding the scrap value or the residual value, which is reaped by the organization at the end of the useful life of the asset. So here we have to understand that the useful life of the asset is 12 years, and the scrap value is the amount which the organization gets at the end of the financial year, at the end of the useful life of the asset. Now, the next meaning is the capability of a fixed asset to provide service to an organization is not eternal. Except for land, all other assets have a limited useful life. Of course, we all know that in case of any other asset, as time goes by, the value of the asset goes down. It does not go up. Why? Sorry, because the benefit that you get out of that asset slowly continues to go down as the years go by. So except land, which I'm sure everybody is aware, that land is the only asset which does not have depreciation, it has amortization. Why? Because the value of land does not depreciate. If you are talking about any, you might ask, there might be a question that comes to your mind that okay, in what about farming land? Because farming land, if you keep on farming, there's one point of time beyond which the fertility of the land might be lost. Yes, that is true, but in financial terms the value of the land does not get lost. So automatically land has a valuation which actually goes up. Other than that, any other kind of asset, the valuation of it goes down. So other than land, any other asset has a limited useful life, and therefore the service provided by that particular asset is limited to a certain extent. Therefore we can all talk about that capability of the fixed asset to provide service to the organization is not eternal. And where did we get this term depreciation? When we go before we go further, let's understand where did we get this term depreciation. Depreciation comes from the Latin term depretum, meaning reduction of value. We all understand that reduction is the main purpose for us to account for that reduction. Regular usage causes the assets to lose their potential. These losses are considered as expired costs. Next, according to the International Accounting Standard, depreciation is the allocation of the depreciable amount of an asset over its estimated useful life. So we all understand what that means. Depreciable amount. It is the cost of the asset or any other amount substituted for cost less its residual value. Now, I find there's a single typo. There's an L missing. Sorry for that. Okay. Now, depreciable amount is. We'll come to the later part. Those areas later on when I'll give you the example. Now, depreciable value and residual value. Suppose there is an asset which is having a the valuation at the time of purchase. The asset was 1 lakh rupees, and we already know that the useful life of the asset is probably 10 years. So if I am simply allocating every year, if I deduct 10,000 every year for next 10 years, every year if I'm deducting 10,000 from the asset balance, automatically at the end of the 10th year my asset balance is going to be zero. So the amount that I'm deducting every year from the main cost of the asset is my depreciable amount. uh, next is residual value, the amount which is left at the end of the some useful life of the asset, which is, suppose my cost of the asset was 1 lakh 20, and I know if I go and sell the asset after its useful life, the scrap value that I'm going to gain from the sale is maybe 2000 rupees. So my residual value is that 2000 rupees which I'll get from the market if I go and sell. What are the different let's come to what are the causes of depreciation. Why does depreciation actually happen? Simply put, there are so many of the causes which we have discussed here. Wear and tear, simply put, wear and tear means any kind of, due to the usage of the regular usage of the machinery, whatever uh, problem or whatever usage is happening of the machinery. Suppose there's a factory, and in that factory there are two machines which are running. So if and both of them are running for 8 hours, that's an 8-hour shift, probably the machinery is running for 8 hours continuously. So when there is a 8-hour shift in which two machines are running for probably n number of days, and if the machinery is having a certain usage every day, then automatically its wear and tear is going to be higher. Now let's consider another scenario. Suppose the same machinery, the same machinery, if one of them, the same situation, if one of the machinery is, suppose, machine 1, and the second machine is machine 2. The one machine is being used for 6 hours, the other machine is used for 8 hours. So automatically we can understand the machinery which is being used for 6 hours, its wear and tear is going to be lesser as compared to the machinery whose number of working hours is 8 hours. Because if I consider daily a weekly time period of 8 hours into 5 days, which is 8 5 is 40 hours. So out of those 40 hours, the machine 1 is not running for 40 hours, it's running less than 40 hours because it's running for only 6 hours per day. And in case of the second machinery, it's running for the entire 40 hours as long as the shift is open. So automatically the wear and tear of machinery 2 is going to be higher as compared to machinery 1. So the sorry so the problem is, the wear and tear will depend on the usage of the machinery, how frequently the machinery is getting used. The next situation is decay. Decay means a situation where the machinery is going to lose its value to some extent, probably not that fast, due to the passage of time. Suppose we keep everything else constant, like in economics we usually use say it as ceteris paribus, everything else is constant. Only if we just look at the machinery from the point of view that whether how long the machinery has been lying with the organization or lying at the factory, there is going to be a certain amount of decay because of the passage of time. So that is going to be the decay part, which also causes a certain amount of depreciation. Okay, next is destruction. Destruction is, suppose, another example, destruction means, suppose there is a huge workshop or a huge factory work floor where there are a lot of machines which are working. Now suddenly, due to some unforeseen event, a fire breaks out, or there is some kind of destruction which happens due to some natural calamity or something, a part of the machinery gets destroyed, or a part of the machinery gets affected due to that natural calamity. Of course, the maintenance crew comes, they maintain it back, they put everything else in order, and then the machinery is again good to go. But the problem is, whenever you are replacing a spare part with the original, then automatically the efficiency of the machinery might not be as good as it was before. So automatically destruction is one of the another reasons why depreciation may occur. All right. Inadequacy, another of the factors in inadequacy, which means that sometimes the amount of work done by the machinery is not adequate, due to which depreciation also occurs. Obsolescence, this is very very important. This is one of the very pertinent reasons why depreciation is always should be and should always be considered, and that is But in case of obsolescence, it means suppose there is a huge change in technology over the years. The the way in which production system has been carried out has changed hugely. So there is always a chance that suppose your machinery, as we say, as I said before, and as we understand that a machinery is a fixed asset, so it is going to be used for quite a couple of years. So suppose you are buying the machinery today, you don't plan to sell the machinery within the next 3 years, right? You plan to use the machinery for next 15 years. By the time, and there is always a possibility that in the interim period of 15 years there is always going to be a chance that there's going to be some upgradation of the technology, due to which your current machinery is not as upgraded as the newer ones. So automatically, due to this obsolescence, suppose your machinery is giving you a production of 10,000 units in a particular month, but the same category of machinery with the same strength, with the same horsepower, with the same everything else, just it's got an upgradation, and that upgraded model is will be able to provide 15,000 units in a particular year. So automatically, as an organization, you are losing on that part, because you don't have that upgraded machinery, you're using the older version. So that obsolescence also has an effect on the depreciation amount, that whether that obsolescence is going to cause some amount of depreciation. Again, the passage of time, as time goes by, your machinery loses value. Depletion is actually the concept where depletion comes here is this is depletion has two sections. One is extractive and one is regenerative. In case of depletion means suppose there's a mine, a gold mine, or iron ore. These are sources, these are resources which deplete as you use, and they do not recover back again. Suppose there is a iron ore, or there is a mine which where you are extracting some metal, or you are extracting some items. Once that mine has been completely extracted, there are no other precious metals or no other resources left in that particular region. Then that region does not regenerate anymore. There are no chances that it's going to produce a fresh set of resources within next 10 to 15 years. That is not possible. That takes a lot of big lot of time, millions of years probably. So that is one of the reasons why your asset might get depleted. Another one is regenerative resources, which are like suppose fishing industry. You are fit when there is a, if it's a fishing industry, you extract the fish, there are chances that that region will again regenerate itself and get fresh supply of fish. Another example, the farming industry, the cattle industry, all these are resources which are getting used but they get regenerative. All right, so these are all the causes which happen, due to which depreciation has to be considered. Okay, now what are the let's come to the factors which are what are the factors in measurement of depreciation. The following are the factors. First of them is the cost of the asset. Second is useful life. Third is residual value of the asset and other factors. Now, out of the cost of the assets, this is one area where sometimes some of us get confused as to what will be considered as the cost of the asset. Cost of the asset is actually going to include any and every kind of expense other than the price of the machinery, which is going to be added while you are considering it for accounting purposes. Suppose, for example, when there are a lot of situations where there is a confusion regarding what expenses will be considered and what expenses will be added while considering the cost of the asset. Suppose the invoice price is 10 lakh 1 lakh rupees. There is a labor which has been employed for installing the machinery. There is some other installation charges which have been paid by the organization for installing the machinery. There is some sort of transportation which has been required, which is required for the organization to procure the machinery from the vendor point to the factory point. So all these expenses are going to be added. Along with that, there are legal costs which should also be added, and they all should be added, and that becomes your consolidated cost of the asset. If only during while doing a particular problem or solving a particular sum, we only consider the invoice price of the asset, then our problem solution might go wrong. It's not might, it will go wrong, because you will lose marks there. Because the moment you write cost of the asset, all these factors should be added, all these expenses should be added, and only then that entire figure, added up figure, is actually the cost of the asset. So now, why does it affect the depreciation? Let us understand why does it affect the depreciation. When I'll go to the methods of doing the depreciation, I'll explain why does the cost of the asset actually affect the amount of depreciation which is being charged. Useful life of the asset, suppose it's 10 years, it's 12 years, it's 15 years, it's 6 years, 7, 8 years, anything. The useful life of the asset will also affect the amount of depreciation or factors, which it's another one of the factors which is going to affect the depreciation amount. Next is residual value of the asset. All these factors are going to come. Next is, what are the other factors which may be affecting? Replacement cost may be one of the reasons. What is replacement cost? Simply put, why am I actually accounting for depreciation? That is one of the basic questions that we need to understand. Why do we need to go ahead and do depreciation? There are, the very next slide is going to address that area, that why do we need to do depreciation. But let us first understand what is the need for depreciation. Ascertaining correct cost of production. When you will be handling the costing part, if you when you have a cost accounting in your syllabus, and when you will be handling cost accounting, you will realize that there are lots of expenses which are being considered while ascertaining the cost of production. What is cost of production? Cost of production is simply meaning that while producing one unit of a particular product or a particular item, what are all the costs that the organization incurs? Now, you might have a question that when I am producing 10,000 units together, then the cost of the machinery, or the amount of effort that the machinery is putting towards that one single unit, is very negligible. Yes, true, absolutely true. The amount of effort that one single unit is getting from our one particular machinery is probably negligible, but yet the the amount of, if you are ascertaining cost of production, there is always a need to understand how much has every single factor contributed to the cost of that particular single item. So ascertaining correct cost of production is one of the basic reasons why we need to understand depreciation. Next is ascertaining correct profit and loss. Now, if I'm sure that all of us are aware about how a particular balance sheet looks, and we all know there are two sides of the balance sheet. There is an asset side and there is a liability side, right? Now, on the asset side, all my fixed assets appear. Now, I have been discussing the useful life for all this time. Now, let us consider a scenario that in the year 2000, the organization purchases a quick machinery, okay, and suppose somewhere in June, July, or wherever. So if the organization is purchasing a machinery in June and July, and it is for next 12 years, so for next 12 years the balance sheet is going to show that machinery, suppose the machinery cost is 10,000. Sorry, excuse me. So the machinery cost is 10 lakh. So the machinery is going to appear in the balance sheet of that organization for next 10 years, or whatever is the useful life of the asset. Now, suddenly it is purchasing in 2000, so if it's 10 years, effectively in after 2010, which is in 2011, the machinery should not be showing in the balance sheet. Now, suddenly, for 10 years, the machinery has been showing as 10 lakh in the balance sheet, and we do not charge any depreciation. Suppose we don't charge any depreciation, and it's constantly there is a fixed asset amount of 10 lakh in the asset side of the balance sheet. Now, suddenly, in the 2011, in the year of 2011, in the 11th year, when we are preparing a financial statement, there is no machinery, because there is no machinery in the factory outlet itself, because I've already sold it off at scrap, because the useful life of the asset is done. So there is, of course, an absolute possibility that the profit of the organization will get hugely and adversely affected because of that sudden gap in the balance sheet which is getting created due to that absence of the machinery. account in the balance sheet. So in order to find out the true and fair view of the financial position, and also to understand what is the profit and loss over the years, I need to ascertain a certain amount of money. We always know that depreciation is not, it's a charge against profit. We always mention that when we explain that what is a charge against profit. A depreciation is a charge. It means that whenever, if your profit is suppose 1000 rupees, then, and you are not charging any depreciation, it means you are not accounting for that depreciation part, so automatically your profit is showing you an inflated figure. So in order to avoid that, and in order to show the true financial position, the organization should always charge depreciation, and should always ascertain how much depreciation is getting charged for n number of years. Okay, now next is ascertainment of profit and loss on sale. This is another thing. Suppose the machinery is purchased in 2000, the example that we were discussing. The machinery is purchased in 2000, and that machinery is useful for next 10 years. So ideally in 2010 I should be selling it at scrap. Now suddenly, in somewhere after using it for a couple of years, maybe 2 or 3 years, I find that I have enough funds and I can replace that machinery, because there is a better and an upgraded model which is already available in the market, so I want to sell that machinery. Now in order to sell that machinery, I have to understand whether the machinery is being, if the machinery is being sold, then that machinery either should be in a profit, has to be a profit or a sale or a break even of my sale. Now if I am not charging that depreciation, then I don't know how much the machinery has got reduced, how much the value of the machinery has got reduced over the 5 years that I have used it. And then I'll also not be able to quote the price to the seller buyer, that okay, this is my machinery cost. My machinery cost was 10 lakh. Over the years I have used it, so it has depreciated by 1 lakh 50,000. Probably my machinery is costing 8.5 now, so I will be ready to sell the machinery somewhere not less than 8.5. Now I'll not be able to quote that price. I will be in the dark regarding the price, the depreciated value of the machinery. And even if the person tells me that I'm going to give you the give you only 7 lakh rupees for the machinery, I will be happy, because I will not realize that actually I'm having a loss scenario of 1.5, because my depreciated value of the machinery is actually 8.5 and not 7. So I have to account for the depreciated amount very clearly, so that I am able to ascertain whether, when I am selling the machinery to the buyer, I am actually at a profit situation or at a loss situation. Of course, if I'm not able to identify that, my financial position will not show me the true and fair view. So that is another thing. Maintenance of capital is one of the reasons why, as we said that when I had started the lecture, I had told that machinery or any kind of fixed asset is a capital expenditure. So my assets are going to be a long term investment for me. So in order to maintain how much of my capital investment is going in behind that particular machinery, I need to calculate the depreciation. Providing funds for replacement, of course, every year if I'm putting some certain amount of money as a charge against profit or as a depreciation, then I'm already creating a fund. It's a fictitious fund. It is not going to be a scenario where you every year you're going to say, you're going to see your bank account is getting inflated by 5,000 if you're charging depreciation of 5,000. No, but it is a fund which is, in accounting terms, that fund is getting created, so that at the end of the useful life of the machinery, if you want to buy a fresh machinery, you don't have to think about where, how will the funds be arranged, because you have already created that fund in your accounting books. And when we talk about funds in accounting terms, funds is not similar to cash. Fund and cash, they are two separate things. So when I say fund, then that has got a different meaning at all altogether. Differentiating between capital and revenue expenditure already discussed. Sorry, already discussed that capital and revenue expenditure is one of the reasons why depreciation should be charged, and meeting legal obligations, of course. Next uh, next slide. Okay, next is methods of computing depreciation. Now you will understand the relevance of all the things that I have discussed once we go ahead and do it. The time, if the depreciation is considered as an allocation of cost or decline in service potential, then there are two methods. One is time based, another is use based. Now according to the syllabus that you have the first two methods which have been discussed in the syllabus, that is fixed installment method and reducing balance method. Other than that, there are some other methods also: sum of years digit method, double declining balance, and the following other method: working hour method, mileage, depletion unit method, service hour method. If depreciation is calculated as a provision for maintenance of capital source of fund, then you have sinking fund method, annuity, insurance policy method, and also revaluation method. Now let's consider the first method, which is the fixed installment or the straight line method. Now, what is fixed installment method? A fixed amount of original cost is charged as depreciation every year. The method requires allocation of an equal amount of to each accounting period. The amount is such that the asset's book value may be reduced to zero. Sorry, uh, book value may be reduced to zero at the end of the useful life. Now, what is this annual depreciation? The cost of the asset minus the residual value divided by the estimated useful life. Now, let's go back to the discussion where we had said that what are the factors that decide on the depreciation. The first factor was the cost of the asset. Now, the cost of the asset is this part, cost of the asset. Now, suppose if my amount of invoice which is for the machinery is suppose 1 lakh, and the labor paid for the installation is suppose 5,000, another 5,000 is for the installation charges, for any other charges. So adding up the 1 lakh plus 5,000 plus 5,000, it comes to 1 lakh 10,000. Plus there is a 10,000 amount of transportation which is also incurred because the machinery needs to come to my warehouse, come to my factory outlet. So total cost of the machinery is actually 1 lakh 20. Now I do not consider 1 lakh 20, instead I only consider 1 lakh as my cost of the asset, where I only consider the invoice price of the asset. In that case, definitely my depreciation will change, because instead of 1 lakh 20, I am considering only 1 lakh as my cost of the asset. So my depreciation will not be, the amount will not be correct. Now again, let's consider the residual value. If residual value is 5,000, instead of 5,000 I only consider 4,000, then automatically the depreciation amount, which is the annual depreciation, will change. Again, the estimated life, instead of, if my estimated life is supposed to be 12,000, instead of 12 I considered 10, then automatically my our annual depreciation will be higher. So every time I am going to consider what is the depreciation amount, my these three factors are the most important of the three factors which will affect the annual depreciation amount. So every time I have to be careful as to what should be the machine cost, what should be my residual value, and what should be my useful life of the asset. So here, if I have just taken a small example, which is the slide visible? I'm not able to make out whether it's visible or not. Anyway, okay.
Yes, ma'am,
Now,
the slide is visible.
thank you so much, Rukarna. Okay, so the fact is here, I have 1,25,000 of the machinery cost. The residual value is 5,000, which is the scrap value. Once I'm getting the scrap value and the useful life is 12 years, so 1,25,000 is the cost of the asset, residual value is 5,000. I subtract the two, I get 1,20,000, and I divide it by the number of years that the machinery can be used, which is 12. The amount, the depreciable and annual depreciation comes to 10,000 rupees. All right, so this is my basic calculation of how to go ahead with straight line method. Now, what are the advantages of this method? The simplest of the advantages is uh, the basic advantage is it's very easy to understand. If you have the cost of the asset, residual value, and the number of years, you simply subtract and divide, and you get your annual depreciation. Here, you have to understand that the book value reduces to zero. This is very interesting. Whereby, what I can say, suppose the example that I had taken, suppose my 10 lakh is my initial value of the asset, or the price at which I have purchased the asset, and the useful life is 10 years. If I subtract every year, if I simply, and there is no residual value, then what will be my depreciation amount? 10 lakh divided by 10,000. So 10 lakh divided by 10, which is 1 lakh every year. So every year I'm deducting 1 lakh. Suppose let's consider year one. In the beginning of year one, my amount was 10 lakh. At the end of the year, on 31st of March, my books have closed and I am charging the depreciation, which is 1 lakh. So at the end of the year, my closing balance of machinery becomes 10 lakh minus 1 lakh, which is 9 lakh. That amount is opened, and I open that 9 lakh in the next year, when in the year 2, when I'm freshly opening the books of accounts. My opening value of machinery is 9 lakh. Again, that same year, at the end of that year, I again subtract 1 lakh. And at the end of the second year, my closing balance of machinery comes to 8 lakh, which is 9 lakh minus 1 lakh, which is 8 lakh. Again, it goes to third year. And like this, every year 1 lakh is reducing. So at the end of the 10th year, I find that when I am closing my books of accounts and I'm closing my machinery account, the machinery account turns to be zero. So if you have noticed, again, let's go back to the fact why it does not affect the balance sheet. Why? Because every year when I'm preparing the balance sheet, I am reducing that 1 lakh from the balance sheet as such. So every year the machinery account is slowly getting reduced. Instead, if I had not charged depreciation, what would have happened? Every year I would have written 10 lakh, 10 lakh, 10 lakh, and at the end of the 10th year, I would have written machinery account zero. So that would have affected my balance sheet in a very negative way, which will not happen because I am subtracting the machinery account balance every year by charging depreciation of 1 lakh. So that way, it is easier for you to understand why depreciation should be charged and why not just let it be there. Valuation in the balance sheet is fair in case of straight line method. Some of the disadvantages, points of disadvantages: with gradual use, the usefulness is reduced, but the amount of depreciation charged is constant. Of course, as I go by, when my initial years, the amount of depreciation is 1 lakh. At the end of the 10th year, 9th year, also the amount of depreciation is 1 lakh. But the usefulness in the first year or the second year or the third year is not similar to the usefulness in the 7th, 8th, and 9th year. So there is an anomaly in the system regarding the strict line method. Next point is, as the asset becomes older, sorry, as the asset becomes older, the maintenance cost escalate, yet the depreciation charge is constant. Of course, when we buy a particular item, even if we buying for as a consumer good also, if you buy a particular item, if you buy a laptop, if you buy any kind of item which is of capital expenditure nature, and consider it from the point of view of an organization, when they buy something as capital expenditure, what happens is, at the initial 3 or 4 years, there are maintenance costs are very low. So that time, the amount of depreciation charged is sufficing. But as the years go by, the maintenance cost goes up. It crosses. So automatically, if it crosses, then what happens is, but yet you are charging that same 1 lakh in the first year also and in the 10th year also. So that there is a system which is not going to be very effective if you are charging depreciation like straight line method. Does not consider interest on capital invested on the asset. This is one of the negative points that the straight line method has, that it is not considering the interest on capital factor. Reducing balance method, depreciation is calculated as a fixed percentage on the original cost of the first year. Subsequently, it is calculated the same percentage on the written down values every year. The rate of allocation is fixed, but the amount of allocation gradually decreases. The rate of depreciation is, this is the formula of rate of depreciation, where R is equal to the percentage of depreciation, N is expected useful life in years, cost of acquisition is the C, and scrap value or the residual value. You'll understand this when I do the sum with you. And these are the advantages and disadvantages of the methods. And there are two assumptions that happen here. Service potential of an asset gradually reduces with passage of time, which is one of the realistic assumptions which happens in case of reducing balance method, which is not present in straight line method. An asset is old As the asset is older, the depreciation reduces, but the cost of repair maintenance increases. So here are the two bases in which, now, methods of recording depreciation. Now, when we have discussed the methods of calculating depreciation, there we have discussed two methods, which is straight line method and reducing balance method. Now we are understanding what are the methods of recording depreciation. Recording depreciation has been how this method of passing the journal entries will happen through the books of accounts. That is what the method of recording depreciation is there. Now, there might be a situation where you might get confused as to, if it is straight line method, then we'll follow one method of the first method. If it is reducing balance, then we'll follow the second method. No, there are mainly two methods of recording for depreciation. Both the methods can be used for both the straight line method and reducing balance method. So we will discuss both the methods, and we'll discuss sums on both the methods. And the first method is when no provision for depreciation account is maintained. Depreciation is directly charged to the asset account. At the end of the accounting period, depreciation account is closed by transferring it to the profit and loss account. And the journal entries is depreciation account debit to asset account, profit and loss account debit to depreciation account. If you look at the entire these two journals, you will find that depreciation account is getting cancelled out. So the net effect of the provision, net effect of the depreciation is actually profit and loss account debit to asset account. Okay, now let us go to the second one. Next is second method. When provision for depreciation account is maintained, depreciation is not directly charged to the asset account. It is debited to depreciation account and credited to the accumulated depreciation or provision for depreciation account. Usually, what we usually do in the sums is, if in the sum you are mentioned that show the accumulated depreciation account, you mention it as accumulated depreciation account. If nothing is mentioned, then you can show it as provision for depreciation also. And whatever nomenclature is used in the sum, it is better to follow that nomenclature, so that there is no confusion regarding the which account is being opened for what purpose. And automatically you do not lose marks there. Okay, now let us consider here also, if you are maintaining the second method, where depreciation account to provision for depreciation account and profit and loss account to depreciation. One difference with this method, the first method and the second method, is, if you look at the first method, you are debit the first journal entry is depreciation to asset account. In the second in the second method, the first journal entry is depreciation to provision for depreciation as account. So you understand, in case of second method, the asset account is remaining intact. There are no changes that happen in the asset account regarding the depreciation charging part. Of course, if there is a sale or a purchase of a further machinery, suppose you are buying a machinery, then you are buying another machinery in the beginning of the year and at the middle of the year respectively, then the sale or purchase part will come to the asset account, the respective asset account. But if you are charging depreciation for all the assets and the subsequent assets, none of the changes come to the asset account. They are all the adjustments are done through the provision for depreciation account and depreciation account, and the last adjustment is done in the PL account. Okay, now these are the two methods. So as I discussed, that methods of calculating computing depreciation, which is reducing balance and fixed installment, can also be applied, they can be recorded through both the methods, that is the first method and the second method also. Let me rush through to the next part, which is the problem part. Now I have considered a sum here. This is a particular individual purchased a machinery for 1,02,000 and spent 8,000 for its installation on 1st January 94. The working life of the machine was estimated as 10 years, and its scrap value at the end of the time is 10,000. So if you see, I have already done the explained you how the annual depreciation is going to be charged. See, the original cost of the machinery plus the installation cost, they have not left of the installation cost, they have considered the installation cost. So you are supposed to consider the installation cost. So it's 1,02,000 plus 8,000, which is actually the cost of the asset, and minus the scrap value. Scrap value is given as a 10,000 at the time of selling the machinery. The scrap value will be 10,000, so that is deducted. The entire thing divided by the number of years. Number of years is also given as 10,000. Sorry, 10 years. So it's actually the amount of annual depreciation charged is 10. So now let us consider that what is going to be the journal entry in case of the machinery account. Then this method with and this problem is both a problem of straight line with and without provision. So when we first of all we'll consider the situation without provision, and then we'll go to a with provision situation. Now, what is the first journal entry which will pass? The first journal entry is for machinery to bank, because machinery is getting purchased, so it's an asset. Machinery account debit to bank account 1,02,000. Again, on the same day, a separate entry is being passed, which is machinery to bank account 8,000 and 8,000. So the net effect is 1,10,000 in the machinery account. Now let us consider in the first on the 1st of April 94, this machinery purchase account is appearing. Now let us consider the first, it's 1st January 94, and the books end on 31st December. Sorry. So in the 31st December depreciation account, I'm passing the depreciation journal. So depreciation account debited to machinery account, which is 10,000. That is annual depreciation here, which we have already calculated. And the second one is 31st 1294, where I am transferring the organization is transferring the depreciation to the profit and loss account. So this is the transfer entry. The second entry of 31st 1294 is actually the transfer entry. The next year, the next year, when we are, since we are supposed to give journal entries for first 2 years, we are going to give it for 94 and 95. In the 90, in the year of 95, what happens is depreciation is only, there are going to be two entries. One is the depreciation entry, which is the annual depreciation charge, which is 10,000, and the second entry is the transfer entry, where the PL account is debited and depreciation account is credited. We can find out that depreciation is getting cancelled out, so the net effect is PL account debit to machinery account, the asset account, that is. Okay, here there is no provision which is maintained, so we understand that the depreciation is charged through the machinery account. Let us consider the next situation here. Here, if I'm talking about the machinery account, let us look at the machinery account. The machinery account, we have 1,194. We have the cost of the machinery, which is 1,02,000, and the bank account, which is installation of 8,000. The total amount is 1,10,000. We are charging by depreciation. We are just doing the double entry of it. By depreciation, 10,000. The balance comes to, see, the amount of balance has reduced because we have already charged the depreciation. So the balance has come to 1 lakh, and we bring it down to the next year. The opening balance is 1 lakh. That year also, again, when I'm charging depreciation of 10,000, the balance of amount comes to 90,000. So once it's 95, I'm opening the books of 96 with a balance of 90,000. So within the 2 years that the machinery account has opened, my balance has gone down from 1,10,000 to 90,000, because every year I have charged 10,000 as my depreciation. And in the depreciation account, simply I'm charging to a machinery account 10,000 for the first year, and to machinery account 10,000 again for the second year, and I'm closing the depreciation account by profit and loss account. Now next is the balance sheet for the 2 years. In the first year, 94 balance sheet. Therefore, since there are other items in the balance sheet also, so I'm just writing includes there. Machinery account is showing as 1,10,000 less depreciation of 10,000. Amount is 1 lakh in the closing balance of 94. Let's come to 95, and when I'm opening the machinery account for 95, it's already 1 lakh, and I'm reducing the depreciation of charging depreciation of 10,000. So the closing balance of 95 comes to 90,000. Now this is entirely when I have not maintained any provision. Second second situation is when I am maintaining the provision. I'll not go into the initial entries there. I'm going to just be discussing the difference in the journal entry. If you see depreciation, instead of depreciation to asset, I'm drawing depreciation to provision for depreciation of 10,000 and PL to depreciation. In the second year also, I'm doing depreciation to provision for depreciation and PL to depreciation. So this again has an effect in the machinery account. We just and look at the machinery account, how different it looks as compared to the previous account. Here, just check your balance of 94. The year end balance of 94 is 1,10,000. Again, in the year end balance of 95, it's also 1,10,000, which was not the case of machinery account, which was having no provision situation. This machinery account. So there is automatically a difference between how the machinery account looks in case of a with provision and a without provision situation. The depreciation account stays the same. Only instead of two machinery, I'm charging as two provision for depreciation. I have another fresh account which I need to create because I have opened the provision for depreciation account. So I am so here the when I'm charging the depreciation, it's coming as by depreciation, and I'm closing the books. On the next year, again, I'm pulling up the fresh balance, and then again, I'm charging the depreciation. So the accumulated depreciation balance comes to 20,000 rupees. So provision for depreciation balance is 20,000 at the end of the 2 years. Balance sheet, machinery at cost, less provision. See, there is again a difference between the balance sheet when no provision was maintained and when a provision is maintained. Here I'm not saying less depreciation. Here we are writing as provision for depreciation account for accumulated depreciation of 1,10,000 for both the years. So this is how the difference between a problem with and without a provision account is seen. Now, problem of reducing balance method. This is, there is a organization, the Thompson brothers purchased a machinery by check of 1 lakh. Here the amount of machinery cost is 1 lakh. The scrap value is 20,000. Year end depreciation is provided at the rate of 10%. So when I am charging the depreciation, the depreciation is charged at the rate of 10%. So the first year depreciation for show the machinery account for first two financial years when no provision is maintained and when provision for depreciation is maintained. Now in case of depreciation for 2015, my depreciation is 1 lakh into 10%, which is 10,000. The next year when I'm charging the depreciation, what I'm doing is I'm not charging it on the cost. I am rather charging it on the written down value. What is the written down value? I have subtracted the 10,000 that I have charged in 2015 from the cost of the machinery, and on the reduced figure I have charged the 10% rate of depreciation. So therefore we can see that it's 1 lakh minus 10,000 into 10%, which is equal to 9,000. Which means what? 1 lakh minus 10,000 is 90,000. 90,000 into 10% is 9,000. So therefore, this is the precise reason why it is known as reducing balance method. Why? Two reasons. One is, there are two names here which we are associating. One is reducing balance and another is written down value. Reducing balance, why? Because the balance of depreciation reduces every year. If you look at the balance, this year it's 10,000, this year it's 9,000, next year it's going to be even lesser. So every year the depreciation balance reduces. So that is why it's known as reducing balance method. And why is it written down value? Why? Because I am charging the depreciation on the written down value. Whatever is the value of the cost of the initial cost, I'm not charging the depreciation every year on that. I'm charging it on the written down value. Okay. So therefore, that is the machinery account. This is how the machinery account looks. This is the machinery account. Bank is this. Depreciation is 10,000. Balance is 90. I'm opening the balance for the next year. Again, I'm charging depreciation of 9,000, where my balance is 81,000. So I'm opening the third year balance to be 81,000. My depreciation account looks like to machinery account. Here again, since I'm not maintaining the provision, I'm writing it as depreciation to machinery. My machinery account is getting reduced every year, and the balance sheet looks as this. In case of when provision for depreciation account is maintained, look at the machinery account. Again, the machinery account is intact. There is no change in the machinery account. The value of the machinery is intact at 1 lakh rupees. But accumulated depreciation every year it increases. First year it was 10,000. The next year I have added 9,000, so it's become 19,000 the beginning of the at the end of the second year. Depreciation, I am not writing it to machinery like I have written here. I have written it as to accumulated depreciation and closed it through the PL. These are the two balance sheets. Let's consider the third and the final sum for this session. This is a singular case of profit and loss and sale of asset with provision account on fixed installment method. The firm has purchased machinery of 2 lakh on the 1st October the same accounting year. Machinery costing 1 lakh was purchased. Another machinery was another the machinery which was purchased on 1st October, which was purchased on 1st April, was sold for 90,000. And on 1st October 2002, new machinery was purchased for 2 lakh, while machinery purchased on 110 was sold for 85 on the same day. Provide the depreciation. It's going to let us look at the first of all look at the working notes first. How does the work exactly how the calculation is done? For the machinery which was purchased on 1st of April, I'm going to charge a full year depreciation for that, because it has I have purchased it on 1st of April, and the of the machine that I've purchased on 1st of April, I have sold it in 1st of October. So for 6 months, there's a full depreciation for 6 months, not for full year. So in the months are April, May, June, July, August, and September. 1st of October, I have sold it. So there is a 6 month depreciation. It's a 20,000 here, and next year, and there is a half month depreciation, half year depreciation here. So total adds up to 30,000. Next is, now look at this column. Asset purchased on 1st of October 2000, it's 10,000, 1 lakh into 10%, because it's going to be 6 months from October to 31st March. It's going to be 6 months, so 5,000. The asset purchased in 2002 has no relation in 2001, so there it's going to be nil here. So total depreciation charges, annual depreciation charged against the profits is 25,000. So let's go back to the machinery account. Let us go back to the machinery account. Since it's machinery account, just see the machinery account. There is no change in the machinery account, because I'm not charging the depreciation through the machinery account. I'm charging it through the provision for depreciation account. So in provision for depreciation account, see 25,000 is by depreciation. So we are able to understand that the balance of the provision for depreciation account is closed here, and it's taken to the next year. The opening balance of 2001 is 25,000. Let's go again. Let's go to the working note. For the 2001, 2002, for 6 months, we have already discussed. And for asset purchased on 1st of October in 2000, this year has a full year depreciation, so it's a 10,000. So the adding up the two figures, we get 20,000. So here we have a 20 depreciation account is for both the assets, since the dates are different. So I'm going to write the dates as the depreciation is charged. So one is 10,000 and another is 10,000. Adding up the figures, I have 45,000. Now machinery account, let us go to the machinery account. Machinery account, there is a problem with this particular machinery, because there is a sale situation here. So the sale situation, the machinery account is getting affected due to this. So let's go to the machinery account. Machinery account, provision for depreciation is there, and there is also a sale figure which is here. The original cost was 20,000, depreciated value, loss and sale of machinery is 80,000. Less price realized is 90. So 170 is the depreciated value. So automatically there is a loss of sale of 80,000. And again, there is a original cost of machinery which was 1 lakh, less provision for depreciation of 20,000, depreciated value is 80, and the price realized is 85. So there is a profit on sale. So these two assets have been shown in the machinery account. See, if there is a profit and loss scenario here. So here there is a profit of 5,000, and here there is a loss of 80,000. So that has been considered here. And the provision for depreciation account looks like this, where depreciation is being charged every year. And let us go to the last part, the depreciation account. In the provision for depreciation account, every year the depreciation has been charged and a fresh balance has arrived at. This is the closing balance of depreciation. So through the working note, I can understand when I do the sums of depreciation. It's better that we understand the how the depreciation calculations are done, and then we start with the accounts, so that the working once your working notes are done, you'll be able to pick up the figures and put them in the accounts as and when the occurrences happen according to the dates. So this is the scenario of without with provision, problem of fixed installment, and if there is a profit or loss. This is a situation of both a profit and a loss on sale. Now, change in methods of depreciation, I would have discussed this, but due to the paucity of time, I will not be able to discuss. But it should be evaluated every year, and also the method of depreciation should be changed according to S5. Now, after discussing all these points with you, there's something that I would like to close the session with, is because depreciation is simply a charge against profit. It's not an appropriation, because it is reducing the profit by every year. If you look at the profit and loss account, if this particular profit and loss account, if this particular situation is looked, there is a profit situation here, there's a profit situation here, and there's a loss situation here. This was a profit situation and this one is a loss situation. So when you prepare your profit and loss account, automatically all these effects will go into the profit and loss account, and your accounting process will clearly show how the machinery and how that particular asset, if not machinery, any other form of asset, how that particular form of asset will actually help to ascertain the profit in a proper manner. Also, there is another thing that I'd like to discuss is, we have discussed only one asset, which is a machinery. There is a possibility that you might have two and three machineries, but when you are doing machinery account, you will have only one machinery account where you will record all the transactions of machinery itself. That is going to be one single category. You can't have machinery one account, machinery two account first. Secondly, if you have a furniture fixture, you will have one single block of furniture fixture. According to taxation rules, you will have one single block of furniture fixture, one single block of machinery. So they are all treated as block of assets. So you will not have, if you are buying 10 machinery, it does not mean you will maintain 10 machinery accounts. You will maintain only one machinery account, where you will identify each and every single machinery with some identification process through the accounting norms. And if it is a furniture fixture, you will only have one furniture fixture account, and the provision account for furniture fixture will also be one single. So all your transactions, all your adjustments will go through that particular machinery account, or that provision for depreciation on machinery account. And if it's a furniture fixture, it will go to furniture fixture account, or provision for depreciation on furniture fixture account. All right, so this is where I would actually like to close the session. As to, I hope whatever basics I have been discussing, it has been a bit of a help to all of you. And I hope whatever areas, problems you have, in case you have any issues, I'll be having my mail ID where you can actually send me any queries if you have. Thank you, all the organizers. Thank you so much, Shukana, for being there and helping me out. Thanks a lot. Thank you so much, sir. Thanks, KBSSA, for this opportunity. Thanks a lot.
Thank you, ma'am. The session was really very informative. It was really very useful. Thank you so much, ma'am. Hope to hear from you again, ma'am.
Thank you so much, Shukana.
Thank you,
Thank you,
ma'am. Thank
sir.
you, and kindly
Thank
check
you,
your email.
sir. Thank you so much, sir. Thanks everybody who has been helping out for the session. Thanks a lot. I'll leave, sir.
Okay.
Thank you so much.
So the next session will be taken by Abhijit Kundu sir. Abhijit Kundu sir is presently serving as an assistant professor, Department of Commerce, Barakpur Rashtraguru Surendranath College, Barakpur. He also teaches as a guest faculty at the University of Calcutta's Department of Commerce. He has written many research papers in peer-reviewed journals, in addition to book chapters and articles in conference proceedings. He has presented several articles in national and international conferences and also published a number of research papers or articles in different reputed national and international journals, including seminar proceedings and edited books. So I request you, sir, to please take over the session. Over to you, sir.
Thank you very much, Shukonna, for such nice introduction. Am I audible?
Yes, sir, you're audible, sir.
Okay. So at the outset, very outset, I want to also thank to the society for giving me this wonderful opportunity to be part of this unique lecture series. And today's lecture would be on input tax credit under GST. So let me share my slides. Is it visible?
Yes, sir, it is visible, sir.
Okay, so I'm going to speak on the input tax credit under GST, and this is part of the BCom Honor Semester Semester 5 course under University of Calcutta. They have a core paper 5.2 CH Taxation 2, and also this part is also there in the BCom General Semester 5. This is the DSC paper. That is also the name of the paper is Taxation 2, and there is a module 2, and the module 2 considers the indirect taxation where we have GST as well as customs. So this is a part of the GST, which is known as the input tax credit. Now, the input tax credit is very important and very interesting, and we can say that this is the lifeline of the GST, goods and services tax. Okay, and many students found it very confusing, very complex. But I must say that if we go through the syllabus, this either it may be become honors or become general syllabus that you have, only a very basic part, only a small portion of the total provisions that is related to the GST is covered in your syllabus. And I must say that if you understand these basics clearly, logically, then there should not be any misconception, there should not be any fear regarding this particular topic. Okay. And I must say that this is a very scoring topic that way. If you understand it properly and do some basic problems, then you can attempt those questions and it will be very scoring that way. Okay. So with this background, let me start with this the short brief deliberation on the input tax credit under GST. Now, before I start, I just want to say that what we are going to teach today, this is, first I will start with the concept of the ITC, that is called input tax credit, and some related definitions I will discuss. And thereafter, I will show you how actually this, input tax credit is utilized, the application part of the input tax credit. And last, I will end up with some discussion of some procedural aspects, the provisions related to some procedural aspects of availment of the input tax credit, obviously if time permits. Okay, so these are the three things broadly I want to take care in this short lecture. Now, before I start directly go to discuss about the concepts of ITC, that is input tax credit, few things as a background I think you need to know. Though I know that you know this, but still it will create a good premises for my proper teaching in this particular lecture series. Now, first thing in the GST is very important, that is called taxable event. Now, what is taxable event? So taxable event, taxable events, by taxable events, we always mean that's any transaction, any occurrence or happening of any event that actually results in a tax consequences. So it's a happening of something that actually uh, leads to a tax liability. Clear? So it determines the point at which tax would be levied. So suppose in case of income tax, if you have an taxable, if you are during the year earning above the taxable limit, then you have to pay the income tax. Suppose if you are making an importation or exportation of goods, then obviously there can be you may have to pay the customs duty. Okay, like this, when we have to pay GST. So what is the taxable event under GST? Okay, so this is nothing but supply. So in goods and services tax, very important, very, very important thing is the supply. If there is no supply, there is no GST at all. Okay, so we have to learn the definition of supply under section 7 and other schedules as per other schedules. So this is very important. So here, taxable event is supply of goods or services or both is considered as a taxable event. Clear? Now, so in simple term, we can say if there is a taxable supply by a taxable person, then GST would be leviable. So taxable person means any person who is registered or liable to be registered, and taxable supply means not, suppose as per the definition, as per the provisions of the act, supply is this is one transaction becomes supply, but this may not be taxable supply. Okay, there may be some exempt supply on which we need not to pay tax. So there is a concept of taxable supply on which we are supposed to pay tax. Clear? So if there is a taxable supply made by a taxable person, then only there is a question of payment of GST or levy of GST. Now, second thing, suppose there is a supply. There is a taxable supply by a taxable person. Now, GST would be applicable. So, we know there are different types of GSTs applicable. So, on what type of supply, which type of GST we have to pay, on that basis, supply can be of two types. One is called intrastate supply, another one is called interstate supply. So these are very simple definitions are there. So like inter college football tournament or intra college football tournament. Suppose if we call inter college football tournament, that means many colleges are participating in that football tournament. Okay, so like this, in case of interstate supply, what does it mean? That's whenever the location of supply, that is who is supplying, and the place of supply, that is to whom it is being supplied, or the recipient of the supply of goods or services, are in two different states or in two different union territories, or in a state and a union territory. That means who is supplying and who is receiving the goods, they are not within a same state or same union territory. Okay, they are at a different locations. If it is so, that is called interstate supply. Clear? And if it is the supplier and the receiver both are within a single state or within a single union territory, then it is what is called intra-state supply. Just like an intra-college football tournament, that is within a college there is a football tournament, no outside college students will be participating in that football tournament, only different sections or group of students can enroll there. So it's called intrastate supply. So when the supplier and receiver both are there within a state or within a uh, union territory, that their locations are both within a particular state or union territories, it is called intrastate supply. And if they are residing in two different states or in two different union territories, or supplier is there in a state, receiver is an union territory, like this, then we call it that interstate supply. And in this connection, just to tell you that if anyone is making importation of the goods, okay, that is also treated as interstate supply. So some people, some registered person or someone is importing goods who is there in the Maharashtra from the outside India, so that would be considered to be an interstate supply. Clear? So now, if suppose we have already come to know what is interstate supply and what is interstate supply. Now if it is interstate supply, what type of GST would be applicable? IGST, that is integrated GST would be applicable. But if it is an intrastate supply, then what type of GST would be applicable? That is CGST and SGST or UTGST. Okay, so we have to pay both of these. So if it is within the state or within a particular union territories, then we have to pay two things: CGST plus SGST, UTGST. And if it is interstate supply, then we have to pay only one tax, that is called IGST. Now, when we have to pay, suppose there is an intrastate sale, when we have to pay CGST and SGST, and when we have to pay CGST and UTGST. So just here I have written that for all other states, okay, for all other states and Delhi, Puducherry, and Jammu and Kashmir. Okay, so remember, for all the, this should not be all other states. It should be all states. For all the states, every states have their own legislation. Okay, assembly. So these states can frame their own laws. So if these intrastate supplies are made in within a state, okay, then obviously what GST we have to pay? CGST plus SGST, because that state has its own SGST act. But in addition to that, there are certain union territories which has their state legislation. So if they have their own assembly, their law framing institution is there, then obviously they can also frame their own law, and there is only in those union territories also we have what we have to pay: CGST and SGST. So Delhi, Puducherry, and Jammu and Kashmir. Okay, if any supply is made, suppose supplier is also there in Jammu and Kashmir and receiver is also there in Jammu and Kashmir. So what type of GST we have to pay? We have to pay CGST plus SGST. Though these three are union territories. Okay. But for all other union territories like Chandigarh, Andaman Nicobar Islands, Lakshadweep, Dadra Nagar Haveli, Andaman Diu, Ladakh, okay, they cannot frame their own law because there is no state assembly. Okay, so for them we have one particular act that is called UTGST. So if supplier and the receiver are both there in the Chandigarh, clear, and what type of tax we have to pay, then we have to pay, and this is interstate supply because this is within a particular union territory. So then we have to pay CGST plus UGST. The simple thing is that if from Telangana, a supplier from Telangana is supplying goods to the West Bengal, then this is intrastate supply. What GST would be applicable? IGST. If one person who is there in the Port Blair, Andaman Nicobar, this is an union territory, from this supplying to the Orissa, okay, two different locations, supplier is in Andaman Nicobar and receiver is in Orissa. So it's interstate supply. So what type of tax GST would be applicable? IGST. But if it is suppose a person who is there in the Gujarat from here selling to another place, goods supplying the goods to another place in Gujarat, both the supplier and receiver is the same state, then what type of GST would be applicable? And this is a state, so CGST and SGST. But if suppose it is in Ladakh, so Ladakh is an union territory having no state legislature. So Ladakh, suppose one person, supplier is also there in the Ladakh and receiver is also there in the Ladakh. So it is a case of intrastate supply. Then what GST would be applicable? CGST and UTGST would be applicable. Clear? But if it is Puducherry, suppose if it is Puducherry or if it is Delhi, which have its own state legislature, then what tax we have to pay? We have to pay CGST and SGST. So this is the overall idea. This will be very important for our discussion, later discussion on input tax credit. Now, now I'm entering to the field of the, basic idea about the input tax credit. Now, suppose there is a person whose name is A. Okay, this is A, Mr. A. Now, Mr. A is receiving goods or purchasing goods, okay, from another person who is no, or suppose for the sake of simplicity, one thing we can do this. Suppose this is Mr. A. Okay, this is Mr. A. This is Mr. B. Now, Mr. B is, receiving goods from Mr. A. Now, from the perspective of Mr. B, this would be called as inward supply, and from the perspective of A, it would be called as forward supply, okay, or outward supply. So A is supplying the goods to B. Clear? From the perspective of A, it would be considered to be the outward supply, okay, and from the perspective of the B, who is the recipient, it would be considered to be the inward supply. He is receiving the goods. Now, suppose during a particular month, whatever it may be, Mr. B is receiving the goods from Mr. A. And suppose there will be, whenever A is selling the goods to Mr. B, A has to, suppose this is a taxable supply and A is also a taxable person. So he has to raise a tax invoice, and through which he has to collect the tax. That is the GST. Now, what type of GST would be collected? That I'm not going into the detail of this. Suppose some GST would be collected, and this supply A is making to be at a price of 100 rupees. Suppose value of the supply is, taxable value of the supply is 100 rupees. So suppose simple term, the price of these goods that A is supplying to B is 100 rupees. Now, whenever there is a taxable supply, A has to, suppose this is a taxable supply and A is a taxable person, so A has to charge or collect tax, GST. And suppose GST rate is 12%, so on 100, 12% would be 12 rupees. So finally, what would be the selling price? That would be 112. That would be written in the tax invoice. And Mr. B is purchasing these goods at 112 rupees by paying 12 rupees GST. Clear? So this is the first case. So Mr. A will pay to the government how much tax? 12 rupees GST. Now, this GST can be IGST, this GST can be CGST and SGST, this GST can be CGST and UTGST depending on the situation. So I'm not going to the detail of that. Now come to the to the case of the Mr. B. Now, Mr. B is receiving the goods at what price? Total price of 112 rupees. Now, whenever Mr. B is receiving the goods, Mr. B will, I'm just showing some simple journal entries. There is a very naive type of journal entries that I'm showing here. Okay, actual journal entry may be something different. Okay, So suppose whenever Mr. B is receiving the goods, the journal entry would be purchase account debit 100 rupees. So earlier purchase account could be 112 rupees to A account. Okay, or 112 to A account 112. But now it would be purchase account debit 100. So cost to this Mr. A for purchasing or these goods would be 100 rupees. And when I'm purchasing, I'm also paying some input tax, that is GST input tax. I can debit this account. This is my expense at the time of purchasing the goods. I paid some tax. Just like, at the time of purchasing goods, at the time of purchasing the input, I'm paying tax. That is called GST input tax. In actual life, it can be, whatever GST you are paying, that should be debited, whatever it may be. So GST input tax account 12. So Mr. A account will be 112. So I'm purchasing the goods, I'm making this journal entry. Okay. Now after this, uh, what would happen? Suppose after purchasing, Mr. B is selling the goods to another person, that is called Mr. C. So I'm giving a name to this Mr. C. Now, whenever suppose B is again a taxable person, and this is also a taxable supply. So value of the supply is 150. Again, Mr. B will pay the tax or collect the tax, charge the tax on this bill. Suppose the rate of tax is the same, 12% on this 150 rupees. How much Mr. B will collect from Mr. C? 12 rupees. And finally, the selling price will be 168. So this 168 Mr. B will collect from C. So finally C is paying 160 rupees, including the tax or GST of 18 rupees. So whenever Mr. B is selling this, again a journal entry to be passed. That is C account debit to sales account to GST output tax account, because whenever B is supplying, again B has to pay a tax, that is on its outward supply, that is called output tax. So when I'm purchasing the goods, at the time of purchasing the goods on my inward supply, this is my inward supply, on my inward supply I'm paying some tax, that is called input tax. And when I'm selling the goods or supplying the goods on my outward supply, I have to also pay a tax, that is called output tax. So journal it will be C account. How much to be collected from C? 160 rupees. And to sales account it will be 150, that is the original value of the supply. And to GST output tax account, that I have to pay to the government, how much? 18 rupees. So at the time of purchase of this input, I paid 12 rupees, but at the time of sale or supply of these goods, I have to pay to the government to 18 rupees. So finally, what would happen? So finally, GST payable by B to the government would be net of this. I mean, 18 rupees is the output tax, and input tax, that is I paid at the time of purchase, 12 rupees. So finally, I have to pay to the government 6 rupees. And for the journal would be what? That this GST output account would be debited. Now finally I have to pay 18 rupees, but out of this 18 rupees, I can set off this GST input debit balance by crediting it. GST input tax account 12, and finally bank account, or I have to pay to the government how much? 6 rupees. So from this we got the name input tax credit. That is a balance of this input tax, which is originally a debit balance, now utilized against the GST output tax by crediting it. So a part of the input tax amount is set off against this GST output tax, and this process is known as input tax credit. Clear? And finally, I have to pay how much? 6 rupees. And suppose Mr. C is the final consumer, so he has bought these goods at 160 rupees, and you could understand Mr. C actually finally bearing the burden of payment of total tax of 18 rupees. So total value of these goods is 150, but Mr. C is paid 18 rupees. So that's why we call in indirect taxation, final burden of tax falls upon the final consumer. So Mr. C is paying the total 18 rupees, but how government is collecting it? Government is collecting it through different phases of supply chain. These people are connected in a supply chain. Through different phases of supply chain, government is collecting the taxes. From A, government is collected 12 rupees. From B, government collected to 6 rupees. Okay, so government is collecting 18 rupees from A and B, but A and B again collecting this from the C. So finally, burden of tax falls upon the C, and that's why GST is called a multi-stages tax, which is collected in different stages throughout the supply chain on the value addition made by individual supplier. Clear? So that's why it is called multi-stage tax, and this is an indirect tax, because here burden of tax and liability to pay tax falls upon to different set of persons, because burden of tax falls upon Mr. C, who is the final consumer, but liability to pay, who are liable to pay? Government knows Mr. A and B, actually through Mr. A and B, government is collecting the tax from Mr. C. So this is indirectly collected from C through the supplier, and that is that's why GST is also an indirect tax. I hope this concept will clear the overall understanding about this GST and input tax credit. Clear? Now, just to tell you one thing, in GST calculation, there is another thing happens. So here, the concept that I discussed, ITC, input tax credit, how actually it happens in a simple term. Okay, I consider it under forward charge method. Forward charge method means normally under GST, who is liable to pay tax? GST, the supplier. So in the first case, when A is supplying the goods to B, so A is liable to pay tax. When B is supplying the goods, goods to the C, so B is liable to pay the tax. Okay, so this is called forward charge method. That is supplier to pay tax on its outward supply. Clear? But sometimes there is another mechanism that is called reverse charge mechanism. This is called in short RCM, reverse charge mechanism or reverse charge method. So sometimes, either because of in the act, it is specifically mentioned that in such cases, it is not the supplier, but the recipient has to pay tax, or sometimes it may so happen in some specified cases, your supplier is unregistered, but your receiver is registered. So in some specified cases only, instead of supplier, the burden of payment of tax shifted from the supplier to the receiver. And in that case, what happens? Receiver has to pay tax on its inward supply. So normally, GST has to be paid by the supplier on its outward supply. But sometime, in some cases, okay, receiver has to pay the GST on its inward supply. That is the case of RCM. So in our discussion, we are not covering these RCM cases. Okay, so this is the two cases we can have normally how GST are charged. One is forward charge method, and another one is RCM method. So in our discussion, today's discussion will mainly focus on ITC in the context of forward charge method. And in this particular case, I just want to also tell you one thing, that Mr. A is paying tax to the government, suppose, but at the time of supplying the goods to Mr. B, Mr. A has to raise a document, some bill, that is called tax invoice. So Mr. A is supplying the goods to Mr. A is supplying the goods to Mr. A and collecting the money, okay, and also issuing some documents, okay. So in that document, everything will be written: how much, what is the quantity of the goods, how much is the value of the goods, to whom you are supplying, what is the GST, GSTIN name number, GSTIN of these receivers and suppliers, and what is the amount of tax A has collected. This 12 rupees tax collected, that would also be written, and that's why it is not only known as invoice, it is called tax invoice. On the basis of this tax invoice, the Mr. B can take this input tax credit. Okay, so in addition to the tax invoice, there are many other documents like debit note, there can be bill of supply, because sometimes it so happen Mr. B is getting the goods, or exporting the goods from outside India. This is from USA, they are exporting. So when you are importing the goods from outside India, okay, so in the custom area, you have to pay, in addition to the customs duty, you also have to pay IGST. So this IGST would be also written in the bill of supply. So in case you are importing the goods from outside India, so what would be the document on the basis of that Mr. A will avail this input tax credit? That is called bill of supply. If it is normal sale and purchase, then it is tax invoice. If it is sometime there can be a document called debit note, or sometimes suppose Mr. B has to pay the tax on reverse charge method, then there will be a document. That document has to be issued by Mr. B. So in reverse charge mechanism, what is happening? A is not paying the tax, B is paying the tax and raising the invoice, tax invoice, and paying to the government. Okay, so there will be another type of invoice which will be issued by Mr. B himself. So there are different type of documents. On the basis of this, Mr. B will avail this input tax credit. Detail of this I will come again later on. Okay. Now coming to this, some definition regarding input tax credit related to some input tax credit. Now before I come to this, okay, what is input tax credit and what is not? Okay, just to tell you that input tax will be charged on the inputs. Okay, So this input can be generally of three categories. There will be three types of inputs that you can acquire. Okay. So these are either can be capital goods, this can be either input or this can be input services. So what is capital goods? Suppose you are manufacturing a mobile. Now, in order to manufacture the mobile, you need to purchase some plant and machinery and some other things. So this is actually we call the assets. So you are purchasing some assets which are you are actually capitalizing in your books of accounts and on which you can claim depreciation. So if capital good means a goods which will be capitalized in the books of accounts and on which you can claim depreciation, and this capital good will be used or intended to be used in the course of furtherance of business. So that means you are purchasing some assets, okay, and which will be treated as assets in your book on which you can claim depreciation and which will be used in the manufacturing of that particular mobile, that is to be used or intended to be used in the course or furtherance of business. That means বিজনেসটা করার জন্য আর বিজনেসের যে ব্যবসায়িক যে কার্যকলাপ সেটাকে এগিয়ে নিয়ে যাওয়ার জন্য বিভিন্ন কাজে আমি ইউজ করছি বা ভবিষ্যতে করব বলে যেটা কিনেছি তার উপরে যদি আমি কিছু ট্যাক্স পেমেন্ট করি সেটাও কিন্তু ইনপুট ট্যাক্স হবে। তার মানে আমার ফার্স্ট thing that I have to consider the capital goods is on which on capital goods also we can avail input tax. Second thing is the input. What do we mean by the input? Input means any goods other than the capital goods. That means this input is nothing but normal goods, the expenses of which we normally charge in the revenue account, that is in the PL account on the debit side. Okay, so input means any goods other than the capital goods and which is used or intended to be used by a supplier in the course or furtherance of business. The money capital goods is something different and input is something different. Both of them are goods. Both of these are goods, but this is, actually you are using some assets and this is actually you are using some other, inputs. So in manufacturing of mobile phones, suppose you need some plant and machinery, that would be your capital goods. In manufacture of mobiles you need some small parts or some other goods. You have to some pins, some other small gadgets, or like some revenue expenditure that you have to incur, that is called input. And in addition to that you also may take some services. Suppose you have to take this engineering services, sometimes some legal services, some design, some other works. So this is called input services. So you are, in order to manufacture that mobile you have to pay some fees to your engineers. So at the time of purchasing of this service you also have to pay some tax. So input can be of three types: either it can be capital goods, it can be input, or it can be input services. So this input is only goods, but here input means service. Clear? And on these either capital goods, input, or input tax, whatever tax you pay, it is called input tax. So what is input tax? Input tax in relation to a registered person means either CGST, SGST, IGST, or UGST charged on any supply of goods or services or both made to him and includes made to him. That means inward supply. Clear? So any tax that you pay, that can be CGST, SGST, IGST, UGST, that you have paid at the time of purchase of either capital goods or input services, which will be used or intended to be used in the course of furtherance of business, that is called input tax. And this input tax also includes IGST that you paid at the time of importation of goods. So if you are importing some goods outside India, I already told you, okay, the importation of goods in India would be treated as interstate sale always, interstate supply always, on which in addition to the customs duty, you also have to pay IGST. And on this IGST, okay, that can be IGST on capital goods, IGST on input, IGST on input service, you can avail input tax. And tax payable under reverse charge mechanism. So I'm not focusing much on this one. So input tax is nothing. That input tax means any GST that you pay on at the time of receipt of either capital goods, input, or input service. And what is output tax? Output tax in relation to a taxable person means tax chargeable under this act on taxable supply of goods or services or both made by him to his agent. So made by him to his agent means on his outward supply, whatever supply is making to other persons. And what is input tax credit? Very simple definition, means the credit of input tax, that is setting off your input tax from your output tax. Okay, now it's a simple case I just showed you. So input, suppose this is a person, a taxable person, purchasing some goods, making some inward supply, maybe from outside India, maybe from within India, and suppose some input is purchased. Input means some normal goods, that is the revenue expenditure. Suppose you purchase some input, and on that input you paid input tax at the of rupees 10 rupees. You also taken some services, okay, for your manufacturing production, or for whatever, for your value addition purpose. So that input services, whatever amount you paid for these input services, on that also the supplier from whom you actually got it, they collected 20 rupees tax, GST. So that is also your input tax. And you also purchase some plant and machinery, etc. And that, on that capital good, suppose whatever be the amount of that purchase, you also paid some input tax of rupees 50. Now what is your total input tax? 50 plus 20, 70 plus 10, 80. Total input tax would be 80 for this particular month, or for this particular financial period. Now suppose in that particular financial period, your total supply, whatever supply you made, suppose on that at a particular GST rate you calculated how much, it is 100 rupees you calculated. Now how much finally you have to pay tax? 100 rupees minus 80 to the government, you have to pay 20 rupees. Okay, so this is the concept of this, how input tax would be adjusted against output tax, and total mechanism is known as the input tax credit, because actually debit balance of the input tax is utilized against the output tax. Clear? And always keep in mind, input tax can be generated to a taxable person on account of purchase or acquisition of input, input service, and capital goods. Now, in connection with this, just I have completed my basic part. That is the basic idea of the what is input tax credit, ITC. Now, how to utilize this input tax credit? Here I just told you that total input tax is 80 and total output tax is 100. So set off this one in that particular period. Finally, you have to pay 20. Now the question is that in this 80 rupees, there can be IGST, there can be CGST, there can be SGST. Even in this output tax, there can be different type of GSTs. Now, how these different type of GSTs will be adjusted with each other? Is there any rule? How to utilize them, how to apply them, okay, and how much finally out of this 20, whether this will represent CGST, SGST, or IGST, what will, how this total adjustment has to be made. So now it's getting complex. Clear? So there is, a simple rule for this one, though the provisions is huge quite. But if you go for, it is governed by section 59 of section 5, 49A, 49B of CGST Act 2017. In addition to that, Rule 88A of CGST rules, and in addition to this, there is a circular. So if we go for combined reading of these sections, rules, and circulars, this particular, ordering we can find out. So in the summarized table, I just showed you that in what order the input tax would be adjusted against the output tax. Clear? So if you see this, these are the output tax liability of IGST. That means this is the output tax of IGST, this is the output tax of CGST, this is the output tax of SGST. So far, we are just discussing in a combined fashion. The suppose this is GST, but now we have started discussing in a practical way. That is, now this total GST, how much of this is IGST, how much of this is CGST, and how much of this is GST. Now this SGST also include UTGST. Clear? So what order these various input tax of IGST, input tax of CGST, input tax of SGST would be set off against the output tax of IGST, CGST, and SGST or UTGST. So it's a very simple order. Now, first thing is that 1, 2, 3, 4, 5 actually denotes the order in which you have to proceed. So if you can remember this one, I think it will be very simple. So first, if you have input tax credit of IGST, and you also have the output tax of IGST, first set off the IGST against the output tax of IGST. This is the first thing. So first, input tax credit ITC of IGST has to be compulsorily be set off against the output tax of IGST. Then, if any balance left, that can be adjusted against the CGST and SGST in any order, in any proportion, as per the choice of the person, as per the choice of the registered or taxable person. Okay, so in any order, earlier there was a proportion rate, but from 2019, as per the circular, it has been now withdrawn. So whatever be the choice, whatever be the option that the person exercise in any order that can be utilized. So IGST credit first to be adjusted against IGST output tax, then against CGST and SGST output tax. Okay, so it can be, suppose there is a balance after adjusting for IGST credit against output of IGST. See, this balance can be adjusted 100% against CGST, nothing to be adjusted against SGST. This balance can be adjusted 100% against SGST, nothing can be adjusted against CGST, or 50-50, 60-40, any other ratio as you wish. Clear? So the question is that before we proceed for adjustment of input tax of CGST, SGST, or UTGST, we have to exhaust the input tax credit of IGST. So input tax credit of IGST should be exhausted before we go for adjusting any input tax credit of CGST and SGST. That is written input tax credit on account of IGST to be completely exhausted mandatorily, which is written in section 49A. Okay, mandatory to be exhausted. So first this, and then go for adjusting the input tax credit of IGST against CGST and SGST. Okay, now suppose even if there is balance of input tax IGST, that should be carried forward. That should be carried forward to the next month or next financial period. Now come to the next input tax credit of CGST. Input of tax credit of CGST to be first compulsorily be adjusted against CGST, and then if there is any balance left, it would be adjusted against the output tax of the IGST. Okay, and in no case input tax credit of CGST to be adjusted against SGST, output tax of SGST or UTGST. Likewise, next, so this is the third step, then we go for the fourth step, and then coming to the fifth step, that is the last part, input tax credit of SGST. So if there is any input tax credit of SGST, first it always to be adjusted against output tax of SGST, and if there is any balance left of this input tax credit, it should be adjusted against IGST. Clear? So remember, first you exhaust your ITC, then come to the GST and try to exhaust it. First apply against CGST output tax, then balance should be against IGST, then come to the ITC SGST, set off against the in output tax of the SGST, and if balance left, then IGST. So IGST output tax, IGST output tax, okay, can be deducted in first input tax of IGST to be deducted, then ITC of CGST, then ITC of SGST. Clear? So this is the overall ordering system from which we got it from different sections by reading different sections, rules, and circulars. Now, just coming to some cases. Just see this case, some small caselets. Okay, suppose a case one, input tax credit, how much available, and output tax credit. So during a particular financial period or particular month, suppose. So what is the output? Simple thing is output tax minus input tax that we have to do. So how much is the output tax? 40,000. IGST, this is 40,000. How much is the output tax for CGST? 44,000, 45,000, and SGST 40,000. This is we have to pay, but we have some credits we can utilize. So first, coming to the IGST 50,000. How much is the IGST input tax credit ITC for IGST? 50,000. Where it would be set up first? First, it should be adjusted again IGST of output tax. So less input tax credit IGST. That should be adjusted against this, output of IGST 40,000. So only output tax balance of IGST is 40,000. So I can set up maximum 40,000. So there will be a balance in this ITC, how much IGST? 10,000 out of 50,000, adjusted 40,000 adjusted again the output tax of IGST. So balance 10,000 is left. Now what to do with this 10,000? This 10,000 can be set off against CGST, SGST, or UTGST in any proportion that you wish. Suppose in this case, I considered 50-50. I considered 50-50. So 50% out of this 10,000, 50,000 adjusted against CGST output tax, and 50,000 again SGST output tax. Okay. Now, what is the balance we got after adjustment? 40,000 and 35,000. Now, this balance is completely exhausted, IGST. Now we move to the next CGST balance of 40,000. So CGST balance of 40,000 first should be adjusted against CGST. First should be adjusted against CGST. So adjusting against CGST. Now, total left over balance of output GST after adjusting with the IGST was 40,000, and input tax credit of CGST is also 40,000, so it becomes nil. No balance left. Clear? So nothing to be carried forward. So CGST credit is also exhausted. Now only balance left is the SGST. What to do? So SGST would be set off first, again SGST. So this is the 35,000 balance was left. So this 30,000 will be adjusted again this 35,000. So finally, how much tax has to be paid for this particular month of financial period? This month, no IGST liability, no CGST liability. Only thing that we have to pay is SGST of 5,000. Okay. Now in exam, if this proportion is written, you have to go for, we have to follow that proportion. But if no proportion is written, you can go for any assumption. So write the assumption that I'm going for 50-50 or 100% and 0 or 60-40, whatever. Now in actual life, the company or the person will go for in such a method so that their minimum payment for that particular month will be lower. Suppose in this case, if I go by this way, that 100% to be exhausted, okay, 100% of the IGST excess liability should be utilized against CGST, and then 0% against this. If this type of option that person exercise, then what would happen? First, set off the input tax credit of IGST 40,000 here, balance 10,000 left. So balance 10,000 would be deducted from here. So this balance would be how much? 35,000. If this type of option is exercised 100%, here nothing would be deducted, 0. So this would be, new balance would be how much? 40,000. Clear? So this is exhausted. Now come to the CGST. How much? CGST 40,000 would be utilized again this 35,000, but only amount balance is 35. So you cannot exhaust this. So only 35,000. So what would happen? These 5,000 rupees will be carried forward to the next month. Only 35,000. Now CGST balance would be nil. And finally, what would happen? This balance would be how much? 40,000, because nothing so far is adjusted again SGST. Now this SGST balance to be adjusted again 30,000. So final, this would be 10,000. So just see this, though this type of problem may not come in your final examination. If we go for 50-50, then for this particular period, my SGST is only 5,000. But no carry forward of any other tax. But if I go for 100%, again 100% of the balance IGST against CGST and the other balance against SGST, then what happened? There is a carry forward balance of SGST is there. Input tax credit of CGST can be carried forward to the next month 5,000. But current month, total net tax payable of SGST will be very high, 10,000. So from tax planning point of view, the previous option was good. Okay, but in exam, if you say I'm going for this option and final tax liability 10,000, obviously it would be your final answer. You will get the full marks. But if in exam, though I expect this type of question will not come, that's find out what will be the minimum GST payable for this month. Then this type of trial and error method you have to do. Okay, now there is a logic or is there. I'm not going into the detail of that. Now again going for the another case 2. Suppose there is no SGST input tax, only output tax 30,000 in each case, 30,000, 30,000, 30,000. So first IGST of 20,000 is set off against this. So IGST balance how much? 10,000. So this is exhausted. Now coming to the CGST balance. So CGST balance of 35,000 should be exhausted against first output tax of CGST. So 30,000, say I deducted 30,000. Okay. Now if I deduct 30,000 from the CGST, then how much balance left? 5,000. This 5,000 first would be deducted again IGST. So I deducted it. So now IGST balance reduced to 5,000. Then what would happen? I have to go for the SGST, but in this case there is no SGST. So total 30,000 would be paid. So in this case, what would happen? For this particular month, 5,000 IGST to be paid and 30,000 IGST to be paid. Clear? If in this case, okay, suppose IGST, SGST is also given 37,000, then what would be the case? Then the case would be here, we can adjust SGST 30,000. It would also be nil. And the balance of 7,000, 37,000 minus 30,000 adjusted 7,000 would be adjusted against this IGST liability. So what IGST is only 5,000. So balance would be how much? So there will be nil balance. So everything will be nil, and 2000 SGST credit would be carried forward. So different situation may arise and different cases may be there. And the last case is a very simple case. There is no IGST. Suppose CGST is 20,000 and SGST 30,000, input tax credit is there, and this is their output tax. Okay. So output tax liability 40,000, CGST, SGST 20,000. Now, CGST, no IGST. So first we'll start with the CGST. So CGST credit would be set off first from the CGST output tax 25,000 utilized. So what is the balance of CGST? We have to pay 15,000. Clear? Now come to the SGST. That would be set off against SGST only. But SGST output tax is only 20,000. So we can set off only 20,000. And the balance 10,000, what to do? Balance 10,000, what to do? That can be set off from CGST? No. So balance of SGST or balance of CGST, if any, that cannot be cross utilized. There is no scope of cross utilization. Clear? These we have utilized only 10,000. The balance 10,000 cannot be, we cannot deduct it from there, and CGST liability cannot be reduced to 5,000. This is not allowed. So cross utilization between CGST and CGST and SGST and UTGST is never allowed. This is never permitted, not allowed. So in this case, what would happen? There will be SGST of 10,000 to be carried forward to the next month, and current month SGST liability would be nil and CGST liability would be 50,000. Yeah. And finally, I'm going to a full-fledged problem. This type of problem can be there. So you see the how to solve this type of problem in short. So Mr. Das of West Bengal purchased goods of 20,000 from Mr. Yadav of Bihar. Okay, so how much? 1,60,000 from West Bengal. So you can see Mr. Das purchased goods. This is purchased goods. That means it's your input. It's a good. I'm assuming this is input. So purchasing goods from the same person of West Bengal. So this is what type of thing? Intrastate. And this will come under input tax. So I calculated over there in the solution computation of GST payable by Mr. Das. Here, first I calculated the input tax and then I calculate the output tax and set up the credit from the output tax. So what would be the input tax? In this particular problem, you will also see there is some opening balances of input tax credit is given. So from the last month, some input tax credit balance, brought forward into this month. How much? 10,000, 39,000, 400, 35,400. So opening balance is there. In addition to this, brought forward input tax credit, during this particular month, Mr. Das, who is actually the taxable person or the person here calculating the tax. Okay, he is purchasing from West Bengal, Mr. Yadav. Okay, no. Mr. Purchasing from Yadav of Bihar. So it is interstate on 2 lakhs. So calculating, input tax on inward supply from Bihar, that is interstate. So this is inward supply that from Mr. Yadav of Bihar, I'm purchasing the goods. So it is inward supply and this is interstate supply. And hence on this 2 lakh, suppose what is the tax rate? They said IGST rate would be 12%. So I applied 12%. And how much it's come? 24,000 IGST. In the IGST column, I added. Now, in addition to that, I also purchased goods of 1,60,000 from Mr. Mondal of West Bengal. I am here in the West Bengal and purchasing the goods from another person who is also there in the West Bengal. So it is intrastate supply. So tax on inward supply from West Bengal. So in intrastate supply, on this 1,60,000, we have to pay CGST, SGST. What rate? 6%, 6%. So 6%, 6%, it comes to be 9,600, 9,600. So total input tax comes to 35,000 of IGST, CGST 49,000, and SGST of 45,000. This is the total input tax balance that you can utilize in this particular financial period or month against your output tax of that particular month. We calculate it. So keep in mind there can be some opening balances that should be added with the current month's new fresh input tax. Clear? Now coming to the output tax, that is output tax would be on your outward supply, whatever supply you are making to other person. So in the next para, it is written Mr. Das supplied goods of 4 lakh to Mr. Poddar of West Bengal. Mr. Das is in the West Bengal, supplying goods to the Mr. Poddar of West Bengal. Both are in the same state, locations are same. So 4 lakh, this supply would be intrastate. So output tax on outward supply to West Bengal, that is intrastate 4 lakh into 9%, because here the rates are given to be how much? CGST intrastate. So CGST SGST will be applicable 9%, 9%. So at the rate of 9% will be applicable, and that comes to be 36,000, 36,000. I added them under the head of the CGST and SGST. And then also supply the goods of 1,50,000 to Mr. Hegre of Maharashtra. So from West Bengal supplying goods to Maharashtra, that is interstate, and IGST would be applicable at the rate of 12% on this 1,50,000. So output tax on outward supply to Maharashtra with 3 lakhs. Sorry, I'm wrong. It should be not 3 lakhs. It should be 3 lakhs. Okay, suppose 3 lakhs. So this is 3 lakhs into 18%. So how much I'm getting? 54. So what is the total output tax? I mean, you are liable to pay tax on your outward supply, Mr. Das. Total IGST 54, 36, and 36 CGST and SGST. Now we have to set off. So from this liability, we have to set off this. Now, how to set off? The simple thing that I told you. First, IGST to be against IGST. So 35,000 set off against IGST liability, balance left 20,000. Then CGST 49,000. Okay, so CGST 49,000, first set off 36,000 against CGST. What is the amount of balance left over? 49,000 minus 36,000. Okay, the calculation is showed here in the working notes. So 49,000 minus 36,000, that is your 13,000 balance left. That 30,000 can be set off from your IGST. So I calculated and I written working note, which is also written over there. Okay, so by this your IGST credit and CGST credit exhausted. Thereafter, even after this setup, we have a balance of IGST 7,000 and SGST of 36,000 output tax. Now coming to this setup of use of this ITC of SGST 45,000. So out of this 45,000, we utilize 36,000 to set off against output tax of SGST. So this is also coming to the nil. But what is the balance left? 45,000 minus 36,000, that is 9,000. So this 9,000 now can be adjusted against my this IGST liability of 7,000, but I have IGST liability only 7,000. So I adjusted the total 7,000 again my IGST liability of 7,000. So in that particular month, everything, final liability of IGST, CGST, SGST, everything becomes nil. But remember, there is a input tax credit of SGST is left. That is 45,000 is the total input tax credit, and total adjusted 36,000 minus 7,000. I written over there. Total how much adjusted? 45,000 minus 36,000 minus 7,000. So 2,000 is still left to be adjusted. So it would be carried forward to the next month. So balance of 45,000 minus 36,000, that is adjusted again SGST output, and 7,000 that is adjusted again IGST output, to be carried forward to the SGST input tax, to be carried forward to the next month. So this type of problem, can be there. This is a full-fledged problem. What type of problem can be there, and in different method you can do. This is one particular format I used. Okay. So with this, I come to my this application-oriented part, that is how to utilize this. Now coming to the last part, that is some procedural aspects, some provisions relating to availability of input tax. Now eligibility condition. Now I have some input tax. Okay. So when I can get this input tax, there must be some conditions. There can be some eligibility condition. If I purchase some input or some capital goods or some input tax, input services, always I will be eligible to get this input tax credit. There must be some restrictions. So we have to fulfill certain eligibility conditions. So there are certain eligibility and there are certain conditions. So eligibilities are written under section 16 subsection 1 of CGST Act. And what are the conditions that you have to fulfill? First, you should be eligible to avail ITC, and then you have to also fulfill certain conditions. There are 4 conditions which are stated under section 16 subsection 2 of the CGST Act. Clear? So what are the eligibility conditions for taking ITC? First thing, you must have to be registered. Suppose Mr. B, that if you can remember that person that I could told you, this is the person, Mr. B, is availing the input tax credit. So first, it has to be registered. Registration under GST. It must be registered person, and whatever goods input services or capital goods or services it is acquiring, okay, that should be used or to be used for the business purpose, that is for the in the course of business or furtherance of business. So এটা সবসময় নয় যে তোমাকে সেই সেই মাসে ইউজ করতে হবে, তুমি ওটাকে কিনেছো পরে ইউজ করতে পারো, বাট ইউর ইন্টেনশন ইজ টু ইউজ ইট ফর দ্য পারপাস অফ বিজনেস অর ফর দ্য ফার্দারেন্স অফ দ্য বিজনেস, বিজনেসে ইউজ করবো বা বিজনেসের কার্যকলাপকে আরো এগিয়ে নিয়ে যাওয়ার জন্য ইউজ করবো। তার মানে দুটো যদি কন্ডিশন, তুমি যদি আনরেজিস্টার্ড হও আর তুমি যদি কোনো নন বিজনেস পারপাসে ইউজ করে ফেলছি, আমার বিজনেস আই এম রেজিস্টার্ড বাট whatever input I used and on which I paid input tax, but I am utilizing it for some non-business purpose, then you cannot avail ITC on that. So these two are eligibility condition. And suppose you are eligible, you are registered, you are using or intended to use it for your business purpose, but still you have to fulfill certain other conditions. First, the person should have a valid tax paying document. That is, you are taking the input tax credit on basis of what? So at the time of acquiring the goods, the supplier have issued some document. I discussed already earlier. That's why I discussed there. That's if you purchased, there must be some tax invoice. If you purchase it from outside India, then there must be some bill of supply. If you purchased, sometime suppose in case of reverse charge, there can be some invoice that is raised by you. So there may be different types of documents on the basis of which you can avail this ITC. So the person should have a valid tax paying document where this detail of those tax should be written. Okay. And just to show you that what are those valid documents: invoice issued by the supplier of goods and or supplier, invoice issued by the recipient. I mean, in case of reverse charge mechanism, who is receiving the goods, that person has to raise the invoice and pay the tax. So in that case, the recipient, whatever invoice they are issuing, that would be a valid document. তার মানে রিসিভার নিজেই পে করছে, নিজেই ইনপুট ট্যাক্স নিচ্ছে। ওকে, ডেবিট নোট ইস্যুড বাই দ্য সাপ্লায়ার, টাইম ইজ ভেরি শর্ট, বাট স্টিল I can tell you in a short that suppose sometime it may happen that supplier may issue a document that is called debit note, okay, to where there is a need for adjustment of excess taxable value or for excess rate. Suppose the case is that originally you billed 1 lakh rupees, okay, and collected tax 10,000 rupees, but later on you found actually your bill value should be 1,20,000. So you have to debit your customer by another 20,000, and that's why supplier will issue a debit note. And for this 10,000 again you collect additional input tax credit. So whoever is receiving, that is Mr. B, now eligible to get or avail the tax credit of 10,000 as well as 2,000. And this excess, so if when debit note is issued, if it is found that original, actual amount of taxable value of the goods and service is actual amount is more than the amount of taxable service which is mentioned in the invoice. মানে ইনভয়েসে আমি করেছি 1 লাখ, বাট অ্যাকচুয়ালি আমার গেছে কত 1,20,000, তার মানে আমার ট্যাক্সটাও কালেকশন কম হয়েছে, তাহলে আমি আরেকটা ডেবিট নোট ইস্যু করব, ওকে, টু to pay extra 2,000 to the government and to give the benefit of this extra 2,000 to my recipient. Sometime it may happen that আমি যে কোয়ান্টিটি পাঠিয়েছি বিলে লিখেছি 80 units, but actually পাঠিয়েছি 100 units, তাহলে ওই এক্সট্রা 20 units এর উপর আবার ট্যাক্স হবে। সামটাইম আমি চার্জ করেছি 12%, but actually it should be charged at the rate of 18%. So extra 6%, for this extra 6%, again I have to issue a debit note by debiting my customer. Clear? So that is debit note, and in this case, for debit note would be a valid document for this excess. Okay. So bill of entry, if you under Custom Acts, if you import the goods or services, specifically goods from the outside India, revised invoice, I'm not coming into the detail of this, and document issued by the input service distributor. You just go through this one. These are very, I'm not going into the detail of what is input service distributor. And whatever document you issue, in those documents, minimally these 5 things should be stated, and these are governed by the CGST rule probably 36. So what the detail would be there in those documents: amount of tax charged, most important, with their classifications, description of the goods and services with quantities, total value of the supply goods and or services, GSTIN of the supplier and receiver, that is goods and services tax identification number. It's just like a PAN. Okay, in case of income tax we have a PAN, here we have a GSTIN. and place of supply in case interstate supply. So these minimum details should be there. Clear? So we discussed about the first condition. What is the second condition? The goods and services has to be received. So you have purchased goods, you paid input tax, but the goods is not received in this month. You receive the goods, suppose you purchase the goods in the month of August, but receive the goods in the month of September. So input tax credit you can avail in the month of September. Unless and until you receive the goods, you cannot avail the tax credit of that. Okay. So this is, but if you are purchasing the goods in installments, suppose you purchase the goods in a single invoice of 1 lakh rupees out of the 30,000 received in August, another 30,000 received in September, another balance 40,000 received in month of October, then when you can avail the input tax credit of the total 1 lakh, only in the month of October when you receive the last installment. Clear? So this is proviso to section 16 subsection 2. Tax chargeable under such supply actually paid to the government. So it would be confirmed the supplier actually paid that input tax or paid that tax to the government either by cash or by utilization of those input tax credit. That should be actually paid. And the person actually filed the return under section 39, that is monthly or quarterly return. So if you want to avail, first the eligibility condition is there, and if you want to avail the input tax credit, then there must be a valid tax document. The goods should be received, okay, and tax should be actually paid to the government, and regular return should be made. Clear? So now coming to the last part, suppose this type of problem can be there. Okay, so here it is a one question came in issue. So from the following information, compute the amount of input tax credit admissible to X Limited in respect of various inputs purchased during the month. So goods purchased but not to be used for business purpose. কিনেছি কিন্তু বিজনেসের জন্য ইউজ করব না. Can it be used? See, this GST can be used as an input tax credit? No. This cannot be, because the condition, you may be eligible, but this condition is not fulfilled, so you are not eligible. এটা পাবে না. Goods purchased without invoice, obviously পাবে না. So you have to cite proper explanation for this one and then write no, for this it is not available. Goods purchased from P Limited but tax has not been deposited by P Limited. P এর কাছ থেকে কিনেছি, P এখনো ওটাকে আমার কাছ থেকে নিয়ে নিয়েছে, but P not yet paid to the government. Not yet I will get the ITC on this. Purchases of goods from T Limited for which invoices have been received. Invoice পেয়ে গেছি, but goods shall be received in the next month. So I will get it in the next month, not in this month. এর মধ্যে কোনোটাই পাবে না, proper section cite করে, proper explanation cite করে. So this type of problem can be 4 or 5 marks, nothing. And the last part, time limit for availing ITC relating to financial year. It's governed by section 16 subsection 4 of the CGST, that within which time I have to avail my ITC for a particular financial year. Suppose your financial year is 2021-22, starting from 1st April to 31st March. During the year, lot of input tax I have availed. Now this input tax, within which particular time I have to avail or set off against the output tax. So there must be a limit. আজীবন ধরে ওটাকে আমি ফেলে রাখতে পারি না. So time limit is due date of filing return for the month of September of succeeding financial year or date of filing the relevant annual return, whichever is earlier. তার মানে যেই বছরটা হবে, so let me just, this is also a problem that came in the CU. H Limited delivered a machine to A Limited. H Limited delivered a machine to A Limited on 14th February 2022. 3,50,000 inclusive of GST. H Limited didn't filed. So H Limited কি করেছে, একটা মেশিন ফাইল করেছে, ওকে, ডেলিভার্ড করেছে a machine to A Limited on February, okay, and H Limited didn't file its annual return till October 2000. What shall be the maximum time limit for taking ITC on the basis of such invoice? So what is the time limit maximum? Which is the financial year 2021-22, because this date is within 2021-22. Clear? So first thing is that due date of filing return for the month of September, প্রতি মাসে মাসে তোমার দিতে হবে. So of the succeeding financial year, the A year is succeeding financial year is what? 2022-23. তখন নেক্সট আমরা যাকে বলি আর কি ইনকাম ট্যাক্স অ্যাসেসমেন্ট ইয়ার, তার পরের বছরে সাকসিডিং ফাইন্যান্সিয়াল ইয়ার 2022-23 সেপ্টেম্বর, দ্যাট মিনস সেপ্টেম্বর 2022 মাসের due date of filing return, monthly return under section 39. What would be there? Within 20 days of the closing of the month, তার মানে 20th October, always it would be 20th October or 2022. তার ফার্স্ট ডেটটা বলছে কি, যেই বছরের ক্রেডিট, ইনপুট ট্যাক্স ক্রেডিট, that would be utilized within the September of the next year. Okay, due date of the filing return of the September of the next year. So due date of the next year, September 2020, would be 20th October 2022, or due date of not due date, date of filing of the relevant annual return. Normally due date of filing annual return of 2021-22 year would be 31st December 2022. So whichever is earlier. Suppose in this case, this particular company filed the return on August 2022. So whichever is earlier, 20th October 2022 or August 2022, whichever is earlier, August 2022. So whatever input tax you have collected during 2021-22, you have to utilize by August 2022, whatever date you file the return within that. But if you file the return on, suppose November 2022, then September or October 20th October 2022, or the date when you are filing in the November 2022, whichever is earlier. So within 20th October 2022, you can avail this input tax credit which you accumulated during this 2021-22. So with this, I come to the conclusion of the lecture, and we have understood that various aspect concepts of the input tax credit, various related definitions, that is very important. Okay, and then the most important part from which a lot of sums can be there, utilization of input tax credit, their orders, and finally some theories. So theories can come like, state various conditions to be fulfilled for availment of the ITC, or state two cases where ITC cannot be availed. Okay, eligibility conditions, what are the documents needed, this type of small or short questions can be there. So with this, I come to the conclusion of my lecture. Thank you to the society for giving me this opportunity. I've exceeded my time limit by 6 minutes, sorry for that one. And once again, thank to all the organizations for conducting this program in such a smooth way. Thank you very much.
Thank you, sir. The session was really very interesting. Thank you so much, sir. Hope to hear from you again, sir.
Thank you.
Thank you very much, sir. Thank you. And kindly check your email, sir.
Okay, thank you.
Thank you, sir. Good night, sir.
Good night.